Welcome to the Consumer Financial Protection Bureau's Advisory Committee Roundtable. My name is Zixta Martinez. I serve as the Associate Director for the External Affairs Division at the CFPB. Today's meeting is being held at the Bureau's headquarters in Washington, D.C., and is being live-streamed at consumerfinance.gov. A recording will be made available on the Bureau's website. You can also follow the Bureau on social media via Facebook and Twitter. In a few moments, I'll turn to Andrew Duke, who will kick off the meeting and introduce Director Kraninger. But first, I'd like to welcome our advisory committee members and introduce the individuals who are serving on the Bureau's Consumer Advisory Board, or CAB, the Community Bank Advisory Council, or CBAC, and the Credit Union Advisory Council, or CUAC, during the fiscal year 2019 cycle. Members, when I call your name, please raise your hand. On our Consumer Advisory Board, the CAB chair is Dr. Ronald Johnson. Dr. Johnson is the former president of Clark Atlanta University in Atlanta, Georgia. Liz Coyle is the executive director of Georgia Watch in Atlanta, Georgia. Sami Ilamawi is the chief executive officer of Scratch Services in San Francisco, California. Manning Field is the chief operating officer of Acorns in Irvine, California. Jason Gross is the chief executive officer of Petal in New York, New York. Clinton Gwen is the president and CEO of Pathway Lending in Nashville, Tennessee. Brent Neiser is the senior director of strategic programs and alliances at the National Endowment for Financial Education in Denver, Colorado. Luz Urrutia is the chief executive officer of Opportunity Fund in San Jose, California. On our Community Bank Advisory Council, the CBAC chair is Maureen Bush. She is the vice president of compliance and CRA officer at the Bank of Tampa in Tampa, Florida. Eric Begin is the founder, CEO, and president of Austin Capital Bank in Austin, Texas. Brian Bruns is the president and CEO of Lake Central Bank in Annandale, Minnesota. Aubrey Hoolings is the vice president and operations manager for the Farmers National Bank of Emlenton in Emlenton, Pennsylvania. Heidi Sexton is the executive vice president and chief compliance and risk officer of Sound Community Bank in Seattle, Washington. Jeannie Stahl is the senior vice president and chief risk compliance officer of MetaBank in Sioux Falls, South Dakota. On our Credit Union Advisory Council, the CUAC chair is Rick Schmidt. He is president and CEO of Westar Credit Union in Las Vegas, Nevada. Christopher Court is vice president of accounting and operations for service at Service First Credit Union in Danville, Pennsylvania. Teresa Campbell is president and CEO of San Diego County Credit Union in San Diego, California. James Hunsinger is chief risk officer of Michigan State University Federal Credit Union in East Lansing, Michigan. Brian Price is the president and CEO of Indiana University Credit Union in Bloomington, Indiana. We also have with us Brian Johnson, deputy director for the Bureau, and Matt Cameron, staff director for the Office of Advisory Board and Councils. I'm now pleased to introduce Andrew Duke. He serves as a policy associate director for external affairs and brings 27 years of experience in public policy, including 20 years on Capitol Hill, serving 3 different members of Congress. He received his BA in economics from Hampden City College in Virginia. Andrew?
Thank you, Zixta. It's nice to be with all of you here today, and I'm looking forward to a productive session. My name, again, is Andrew Duke, and I serve as the Policy Associate Director for External Affairs Division here at the Consumer Financial Protection Bureau. I'd like to thank all of our advisory committee members for agreeing to serve in this capacity to help advise the leadership of the CFPB and its director on a broad range of consumer financial issues and emerging market trends. For those live streaming, let me share a brief overview of our schedule today. Following the director's remarks, CAB Chair Dr. Ronald Johnson will conduct the meeting. Chair Johnson will introduce the Bureau's subject matter experts for a discussion on the Bureau's Debt Collection Notice of Proposed Rulemaking, or NPRM. After that discussion, Chair Johnson will then introduce Bureau subject matter experts for a discussion about the Bureau's work to educate and engage consumers. At approximately 12:15, the advisory committees will break for lunch. At 2:30 p.m., the advisory committees will reconvene. Chair Johnson will introduce the Bureau subject matter experts for a discussion about trends in the mortgage market. Then at 3:30 p.m., the advisory committee roundtable will adjourn. As background, the CFPB established its advisory committees to provide substantive information, analysis, operational expertise, knowledge of their communities, and feedback to inform the Bureau's work. As a reminder, the views of the advisory committee members are their views. They are generally appreciated and welcome, yet they do not necessarily represent the views of the Bureau. I am now pleased to introduce Director Kathy Kraniger. Director Kraniger became the second confirmed director of the Consumer Financial Protection Bureau in December 2018. From her early days as a Peace Corps volunteer to her role establishing the Department of Homeland Security, to her policy work at the Office of Management and Budget, to the CFPB, Director Kraniger has dedicated her career to public service. It is my privilege to welcome her to today's roundtable meeting. Director Kraniger, the floor is yours.
Thank you very much, Andrew and Zixta. Thank you to all of you for joining us today, both certainly the CAB, CUAC, and CBAC members who are with me, and those of you who are actually watching us live streaming. I'm impressed. It's an important opportunity, frankly, to have this austere group of people who are experts in their own right in their own field, have the opportunity for a really engaged exchange of ideas and conversation, and something that I truly value in terms of hearing your perspectives and knowing that you are bringing that from many different vantage points of your networks and your organizations. And frankly, that this conversation goes back to those networks and those contacts that you all have. So we've talked quite a bit about the role of the committees and the boards and councils here, and it is an exciting opportunity to, again, welcome you to the Bureau. Certainly want to specifically thank Dr. Johnson and Maureen Bush and Rick Schmidt for serving as the chairs of these respective bodies. That's an added responsibility and one that we truly appreciate in terms of their leadership. In terms of the agenda today, Andrew walked through the things that we're going to be talking about. I want to talk a little bit about the debt collection proposed rule, a little bit about some of our education efforts, and then close, because first and foremost, this is a conversation that we want to have amongst all of you. But worth noting that before the Dodd-Frank Act, no agency had the power to issue substantive rules to implement the Federal Debt Collection Practices Act, commonly referred to as the FDCPA. Under Dodd-Frank, that authority was provided to the Bureau, and last month we issued a notice of proposed rulemaking on debt collection. The FDCPA was passed in 1977. That is the year the first Star Wars movie rocketed into theaters. I think we're coming up on number 9 now, or maybe actually depending on how many of the other offshoots you count, there are many. Elvis left the building in 1977, and a small company called Apple dreamed of putting a personal computer in every home. Back then, people sent telegrams and not emails, called landlines and not cell phones, and mailed postcards instead of sending a text. Let me run through a few of the specific things in our proposal, and let me certainly emphasize that it is a proposal. We are very open to and expect and know that we are going to get a lot of different comments. My hope is that we get a lot of data and evidence from those who comment, and that we can truly take that feedback and input into account as we look at how to finalize this rulemaking to really make the debt collection market work for consumers. First, in a world in which most consumers are accessible 24 hours a day, wherever they may be, they need protection when it comes to when, where, and how collectors communicate with them. Current law already prohibits debt collectors from engaging in acts that have the natural consequence to harass, oppress, or abuse consumers, and bars collectors from contacting consumers at certain times of the day, or when a consumer has said that a time or place is inconvenient. In our proposal, a debt collector would be limited to no more than 7 attempts by telephone per week to reach a consumer about a particular debt. Once a debt collector has a telephone conversation with the consumer, the collector would need to wait at least a week before calling the consumer again. Second, our proposal would allow consumers to stop collectors from using specific ways to contact them or at specific times. For example, they could tell collectors not to call on a phone line or during work hours, or not to send email to a particular account. And when using electronic media, such as email or text messages, debt collectors would have to give consumers an unsubscribe option. Consumers are familiar with this option and can use it to stop the communication. The FDCPA prohibits collectors from harassing or abusing consumers, as I mentioned, or in engaging in unfair practices. These standards apply today and would also apply under the proposed rule. We propose also to make the debt collection process more transparent. Debt collectors must already provide certain information about the debt and consumer rights either in their initial communication or within 5 days of that initial communication. But our research indicates that that's not always sufficient or clear to consumers. So our proposal would enhance the information consumers receive from collectors. For instance, we would require an itemization of the debt to make it more recognizable for consumers, and plain language information about how a consumer may respond. We also propose that collectors explain, again in plain language, how consumers could dispute the debt if they want to. Our proposal would also require the disclosure to include a tear-off or a reply email address where consumers could send back to the debt collector to dispute or discuss the debt. Additionally, we would make clear that debt collectors cannot sue or threaten a consumer over debt of which the period under a statute of limitation has expired, commonly referred to as time-barred debt. This is certainly an area where we expect and hope for quite a bit of comment to understand better how debt collectors are actually addressing this area, what consumer advocates think in this area. So I know there will be robust comments on time-barred debt. And lastly, we would prohibit debt collectors from furnishing information about a debt to a consumer reporting agency unless the debt collector has communicated about the debt to the consumer, such as by sending the consumer a letter. Our proposed rules are designed to let consumers know their rights and collectors know their limits. As the Bureau moves to modernize the rules of the road for debt collection, we are keenly interested in the views of stakeholders and look forward to continued engagement, including our discussion today. Another important topic on the agenda today is a recent study by the Office of Financial Protection for Older Americans, focused on elder financial exploitation. The report draws on a non-public data set derived from suspicious activity reports filed with Treasury's Financial Crimes Enforcement Network from 2013 to 2017. Among other things, the study found that financial institutions reported over 180,000 suspicious activities targeting older Americans since 2013, totaling over $6 billion. More than half of the reports involved a money transfer, and 44% involved either a checking or savings account. Checking or savings accounts had the highest average monetary losses, $48,000 per report. Less than 1/3 of the reports indicated that the filer or the financial institution reported that suspicious activity to a local, state, or federal authority. You know your communities and you know your customers. So I ask you, financial institutions in particular, to take an active role in preventing losses to older adults. And I know it's a priority for you. We've had conversations about it. For instance, money services businesses, too, known as MSBs, could provide conspicuous warnings about scams on forms that consumers fill out, while depository institutions can improve fraud detection technology. The study notes that some states allow financial institutions to put a hold on transactions when staff observe financial exploitation. And such laws provide immunity for institutions and staff that take protective steps. Likewise, the study describes the relatively low rate at which suspected elder financial abuse was reported to adult protective services, law enforcement, and other authorities. And they classify it in the report as a missed opportunity. So financial institutions should consider reporting suspected elder financial exploitation directly to relevant authorities in order to strengthen prevention and response, and keeping in mind that state reporting laws do vary quite a bit. With that, I look forward to the conversation. I want to thank you again for your service. I also want to thank the employees of the Bureau for their service, and frankly, all of those who are in the line of fire, certainly in serving in our military forces, worth recognizing today with the 75th anniversary of D-Day. So thank you again for all the things that you do. It truly contributes to our thinking and supporting America's consumers.
Well, thank you, Director, and I'd like to open the meeting. Good morning to everyone. My name is Dr. Ronald Johnson, and I serve as the chair of the Consumer Advisory Board, or the CAB. I'm really pleased to be joined today by my colleagues from the CAB, as well as the Community Bank Advisory Council and the Credit Union Advisory Council. As chair, I've been asked by the Bureau to moderate today's discussion. First, on behalf of the advisory committees, I'd like to thank the Director Kraninger, because she's here at this meeting, and she demonstrates each time we gather that she's really committed to hearing from the various committees, and that she actually shares back what her thoughts are, and we really appreciate that. I also want to thank, of course, the staff of the Bureau. They have been really excellent, supportive, and always ready to help. I'm really, as the chair of the CAB, I've really enjoyed the camaraderie of the members of the CAB as well, and so with that, I'd like to begin by talking about today's meeting. It was outlined earlier that we have three topics. The first topic involves the Bureau's debt collection notice of proposed rulemaking. The second topic involves the Bureau's work to educate and engage consumers. And the third involves trends in the mortgage market. So we'll begin with the first session related to the NPRM, or the Notice of Proposed Rulemaking. And we are joined by John McNamara, who's the Assistant Director for the Office of Consumer Lending, Reporting, and Collection Markets, and Kristen McParlin, who is a Senior Counsel in the Office of Regulation. Thank you both for joining us, and I'll now turn the meeting over to you.
Thank you, Dr. Johnson. What we'll do now is we'll endeavor to set the table for what I'm sure will be a lively discussion regarding the Bureau's NPRM. I'll go into a little bit of background that led up to the Notice of Proposed Rulemaking, and then I'm going to turn it over to my colleague, Kristen McPartland, who will go into and do a deeper dive of some of the elements of the NPRM, but that will still be a summary. So by way of background, The Dodd-Frank Act, or DFA in this context, amended the Fair Debt Collection Practices Act, FDCPA, to provide the Bureau authority to prescribe rules with respect to the collection of debts by debt collectors. Furthermore, the DFA empowers the Bureau to issue regulations prohibiting covered persons from engaging in unfair, deceptive, or abusive acts or practices, and to require disclosures to permit consumers to understand the costs, benefits, and risks associated with consumer financial products and services, including debt collections. The proposal applies to the debt collection activities of debt collectors that term is defined by the FDCPA. Again, this NPRM applies to debt collectors as defined by FDCPA. The proposal focuses on debt collection activities related to communications and disclosures, and also addresses related practices by debt collectors. The Bureau has been working on debt collection rulemaking for a number of years. We've conducted a wide range of outreach on the scope and substance of this proposed rule since 2013, including some of the following: field hearings, joint roundtables with the Federal Trade Commission, an advance notice of proposed rulemaking, which we issued in November of 2013. We did a small business review practice in August of 2016. We've met with many stakeholders in the debt collection space, and we also read with great interest the comments that we received in the requests for information that were issued in 2018. General outreach has included speaking at consumer advocacy groups, industry groups, visiting consumer organizations, as well as visiting industry and other industry stakeholders to understand how the business operates, as well as the concerns of advocates. A couple of high-level points before I turn this over to Kristen. The proposed rules coverage would be limited to debt collectors who are covered by the FDCPA. The proposal focuses primarily on debt collection communications and disclosures, but also includes a few other provisions that Kristen will go into. The proposal is primarily an FDCPA-based proposal, but a few interventions also are proposed pursuant to the Dodd-Frank Act. And the Bureau is proposing to restate the language and interpret certain sections of the FDCPA. And with that, I'm going to turn it over to my colleague, Kristen.
Great. Thanks, John. There is quite a lot of information in the following slides, but I'll go through them at a fairly quick pace so we can preserve most of our time for the discussion. Starting with the topic of communications, if finalized, the NPRM would provide a bright line rule that would prohibit, with certain exceptions, a collector from placing more than 7 unanswered telephone calls to a person within a 7-day period about a particular debt, and from calling a person within 7 days after the collector has engaged the person in a telephone conversation. This was already mentioned by the director, and a few of the other points we're going to go through today will also be recognized. The NPRM would also provide that a voicemail or text message that contains only specified required or optional content is not a communication under the FDCPA, and therefore it would not be required to include what's commonly referred to as the mini Miranda warning. The NPRM would also clarify that consumers may designate a time or place as inconvenient for communication, and would clarify that consumers may request a collector not to use a specific medium, such as a particular email address or telephone number, and that once that's been so designated, any further communication using that medium would be prohibited. Staying with communications, the NPRM would also clarify that calls to mobile telephones and electronic communications, such as texts or emails, are subject to the FDCPA's prohibition on communicating at unusual and inconvenient times and places. It would require collectors to include in all electronic communications instructions for opting out of further such communications to a particular email address or telephone number. That's the unsubscribe option that was mentioned earlier. It would also prohibit collectors from, again with some exceptions, using an email address that the collector knows or should know is provided by the consumer's employer, and from contacting consumers using public-facing social media platforms. It would propose to identify procedures that, when followed, would provide a safe harbor from liability for collectors who, when communicating with a consumer by email or text message, unintentionally communicate with third parties about a debt. A collector would be entitled to the safe harbor if, among other things, it communicated with the consumer electronically using an email address or telephone number that the consumer recently used to contact the collector for purposes other than opting out of such communications, a non-work email address or non-work telephone number if the consumer first received notice and an opportunity to opt out of electronic communications to that address or number and did not do so, or a non-work email address or telephone number obtained by the creditor or prior collector from the consumer and recently used by that prior creditor or collector to communicate about the debt, again, as long as the consumer did not ask the creditor or prior collector to stop using the email address or or telephone number. Turning to the consumer disclosures portion, the NPRM, if finalized, would provide for certain required and optional content for validation notices. These are the disclosures that are already required to be sent to consumers. Collectors would be required to include certain information about the debt, for example, an account number or itemization of the debt. They'd be required to include certain information about consumer protections, such as information about the right to dispute a debt or to request original creditor information, and required to include a consumer response form that consumers could use to take certain actions, such as submitting a dispute or requesting original creditor information. Collectors would also be permitted to include other information, such as a payment request, a statement about disclosures required by applicable law, information about electronic communication options, such as a collector website or email address, and disclosures about the consumer's ability to request a Spanish language translation of the validation notice. The NPRM includes a model validation notice that would provide a safe harbor to collectors who use it when providing validation notices. Collectors could also send validation notices accurately translated into any language if they send an English language validation notice in the same communication or have already sent an English language notice. The NPRM also addresses electronic delivery of required notices. It would specify that collectors who provide certain required disclosures in writing or electronically do so in a manner that is reasonably expected to provide actual notice and in a form that the consumer may keep and access later. To meet this general standard, collectors who provide required disclosures electronically would need to meet several general deliverability requirements that are described in the NPRM and comply with either the e-Sign Act by obtaining affirmative consent from the consumer or alternative procedures described in the NPRM. The alternative procedures would require collectors to send the disclosure to an email address or telephone number that the creditor or prior collector could have used to send electronic notices under the e-Sign Act, and place the disclosure in the body of an email or on a secure website that's accessible by clicking on a hyperlink included within the email or text message. However, a collector could choose the hyperlink option only if the consumer first received notice and an opportunity to opt out of hyperlink delivery and did not do so. The proposed rule would also provide a safe harbor for debt collectors who follow certain steps when providing a validation notice in the body of an email that is the initial communication with the consumer. Turning to some of the other topics covered by the NPRM, the NPRM addresses decedent debt and provides certain clarifications. For example, the proposal would clarify that personal representatives of a deceased consumer's estate are consumers with whom collectors may discuss the debt. It would also clarify that collectors may locate this person without violating the prohibition on disclosing to a third party that a consumer owes a debt by asking for a person who is authorized to act on behalf of a deceased consumer's estate. It would also require collectors collecting debt from a deceased consumer's estate to send validation notices to and respond to disputes by the executor, administrator, or personal representative of the deceased consumer's estate. As mentioned before, there's also a number of additional proposals, and I'll move through those quite quickly as well. The proposal would require a collector to communicate with the consumer about a debt, which would generally entail sending the consumer a validation notice letter before reporting a collection item to a credit reporting agency. It would prohibit collectors from selling, transferring, or placing for collection a debt if the collector knows or should know that the debt was paid or settled, discharged in bankruptcy, or subject to an identity theft report, subject to certain exceptions. It would bar debt collectors from suing or threatening to sue on a debt if the debt collector knows or should know that the applicable statute of limitations has expired, as referred to time-barred debt. And it would provide rules for the treatment of duplicative disputes, which would be defined as a written dispute submitted within the 30-day validation period to which the debt collector has already responded, unless the consumer provides new and material information. The proposal would also provide a safe harbor against claims that an attorney falsely represented that the attorney was meaningfully involved in the preparation of a litigation submission if certain conditions were met. And finally, the proposal would require retention of evidence of compliance with the statute and regulation from the time the collector begins collection activity on a debt until 3 years after the collector's last communication or attempted communication in connection with the collection of a debt, or the debt is settled, discharged, or transferred to the debt owner or to another debt collector. So obviously a very high-level summary, but we hope it provides some context for the coming discussion.
Well, thank you, John and Kristen. And so we are now open to comments, discussion, and so what Matt explained is that we have the opportunity to have four of you on a queue, and so that if I see that there's a log jam, I'll intervene. If not, we'll just let you naturally flow.
Good for you. Can I just start first by touching a little bit about the institutional incentives around debt collection and servicing, since I think that ties a lot to the behaviors we see in the market. The problem today is, again, I'm a nice guy, but at scale, everything's about institutional incentives. So when you look at servicers or debt collectors today, well, first, because everything is so manually driven, they start looking like in insurance companies. They do the minimal amount of effort in order to incur the minimal amount of cost to make the most kind of margin. Two, you become reliant on all these kind of auxiliary fees, where all of a sudden something like a late fee is a pass-through cost, which might be more than you made on the borrower the whole year. So you're incentivized to not only prevent them from going late, but even after they are, then collect on that. Third is the white label nature of what happens. There is zero delineation or accountability. Any one of these servicers or debt collectors might pick up in the name of the debt provider, and as a result, not feel that, hey, their NPS or their CSAT, they'll be accountable kind of for. And then lastly, and probably most importantly, is, this is the one industry where the borrower has no choice in who their servicer provider is. And so the servicer or debt collector has no incentive to operate or compete on cost or quality or customer care to that borrower. So just taking a look at that as we kind of think of some of the practices that then end up evolving as a result.
Thank you. And Director Kreininger and team, I want to acknowledge how difficult this task is. This is one of those challenging areas where you all are tasked with figuring out the best way to balance competing interests. So I want to acknowledge up front that I appreciate that you're working very hard to strike that balance. I know that you will be getting very robust formal comments, not only from Georgia Watch, but many consumer advocates and others who we want the scale side that we're on is obviously on the consumer side. So with that in mind, I have a few suggestions, and I will say that your summary is very helpful. It is such a complex rule to understand. I think your fast facts, I'm not sure how much you've done to distribute that broadly, but I do think it's a very helpful summary of the key issues that people can better understand what you're proposing to clarify and what new rules you're putting into place. One of the first areas that you all have uplifted is that consumers can opt out from certain forms of communications. And certainly Director Kreininger did a great job of, taking us back. I was around in 1977. It was a great year. But there are new forms of communication. So it is, I believe, important for the Bureau to set some ground rules in this space. I would simply suggest that rather than use an opt-out approach, that consumers at the beginning of the process, when they first find that they are in debt collection land, are able to tell collectors how they prefer to be contacted, rather than allow debt collectors to start texting and using other forms of messaging. You know, and I think it was Director Kreninger who said that consumers are familiar with unsubscribing. That's very true, but most consumers first subscribe before they decide they want to unsubscribe. So I really would encourage you to look at changing the order there. Second, and again, some of this is how I'm understanding the language that's proposed, so I may not have this right, but it seems to me that there is some gray area about whether or not collectors would be required to obtain documentation to prove that they know whether a debt is time barred, whether or not it's too old to be pursued in court. So I do think that there should be more attempt by, I believe the Bureau should require, with very specific language, that any collector, before pursuing action against or threatening to pursue action against a consumer, have the documentation to prove that they would have a case to make in court. I know that the number of calls per week is something that you all will continue to look at and hear about. And while 7 calls per week may seem like, oh, well, 1 a day, that's if you have one debt collector calling on one type of debt. And so it really can be overwhelming. You know, most people who are in a situation who are in debt collection might have a student loan and 2 or 3 credit cards and other forms of debt. So please keep in mind when you're thinking about 7 per week, that if that seems reasonable to you, that it very well be many, many times more than that based on the number of outstanding collections. And finally, I just want to, and I know that it gets even more complicated because I'm going to bring up the topic of medical debt. And obviously that's somewhat treated differently, and the Bureau and regulators have done some constructive things around making sure that credit reporting agencies are recognizing the additional time consumers have. You know, medical debt is something that can take years in terms of even getting the bills sorted out. I'm going to share something that actually happens in Georgia, and it even shocked our Attorney General when I explained to him that this is in fact happening in Georgia. But we have hospitals who, in cases of a car accident, when someone is very badly injured in a car accident, and it goes to, you know, obviously the hospital emergency room, and hospitals will want to be able to take out a lien on the anticipated lawsuit from that occurrence. And unfortunately, and this is happening far too often, some hospitals would prefer not to get the negotiated reimbursement from a health insurance company of the injured party or Medicaid. And so they might not find out if the injured party even has health insurance. And we've had some really heartbreaking examples, and I won't go into some of the most heartbreaking, but of consumers who assumed that things were being taken care of, and they knew that there was, that, you know, they were not at fault, and there's going to be some kind of later court settlement. But somehow that debt is getting reported, and they're finding that their credit scores are ruined. A teacher from Middle Georgia called us. She had had a terrible car accident. Fortunately, she survived, and after quite a bit of treatment, recovered. But because of this process, She was unable to buy a car. She was looking forward to buying a house. It took her years to rebuild her credit. So I use that as an extreme example. Obviously, we're looking on making sure there are ways that hospitals can perfect the lien, still have access to some of the settlement dollars, but wanting to make sure that there's not such egregious reporting of medical debt that even the hospital knows ultimately is not going to be borne by the person who was injured in that case.
Thanks, Liz. And these are both for-profit and nonprofit hospitals?
They are, but most of the examples we're hearing from are actually nonprofit hospitals.
Okay, thank you.
Thank you.
I'd like to see if there are questions from the CUAC or the small bank.
So, no questions, just a couple comments about various items within the proposed rulemaking. I guess the first one, just being information that's included in the validation notice and the requirement for debt collectors to include the validation notice in the body of an email, and just concerns with the information that looks like is proposed on the validation notice might be items that can be easily used by fraudsters to socially engineer institutions that either members or consumers had debts in. It looks like account number might be one of the fields that would be included in that. And again, would have concerns that that's in the body of an email, not in an encrypted fashion. So having that sensitive information behind an encrypted credentialed login would be something we would be wanting the Bureau to consider. Impacts on, obviously, we're a first-party debt collector as a credit union, but we do assign out our loans that are charged off to third-party debt collectors. And with the information, again, that needs to be in the validation notice, likely the impact to us is going to be coordination in a near real-time sense with those debt collectors as they're collecting payments. There's a delay, obviously, when they receive the payment to when that's remitted to us to when everything is reconciled. So as the Bureau considers this rulemaking and when the implementation date of the rulemaking will be effective, just be cognizant of there will be significant third-party systems that will need to be upgraded or put in place that aren't currently there today that will help with that flow of information back and forth. When it gets to disputing a debt, that I believe also will have an impact on us, as we'll need to validate or provide information, extra information to the third-party debt collectors that has been assigned out to. And what we just ask in that process is that once a debt has been disputed and then investigated, if there can be some resolution so that consumers are not able to do multiple frivolous disputes like we see right now in the credit reporting space, where something has already been investigated, thoroughly supported. Having a resolution is important to us related to that. The callback provisions as well for the debt collectors that are collecting on the debt. Once they've had a telephone conversation with a member and the proposal not to be able to call back within 7 days, I think it would be important to consider providing clarity and a carve-out if the consumer during that conversation offers an alternative to having the debt collector call back. Just because they made contact, it might not be an adequate time for that collector to talk to that consumer at that time, but they could say, maybe call me back tomorrow, call me back later today, and just making sure in any final rulemaking that is clear, that an alternative proposed by the consumer is a safe harbor for that collector to call back. And then the provision, the protections around work phone numbers. Also, I think having some clarity for consumers who may have a blended mobile phone experience with their workplace and with their personal experience, and how that type of instrument is classified as either a work number or a personal number would also be important to provide safe harbors to the debt collectors. Either they don't know the difference because that wasn't communicated by the consumer at the time that they established that number with the financial institution or the debt agency. Just making sure that's clear. So those are my comments. Thank you.
John and Kristen, thank you for the great work. I know this is really challenging. Just two very kind of minor comments. First, on the opt-out, particularly for digital channels, I think that opt-out I would encourage you to make that opt-out be immediate and not have some time window, particularly the intensity of that communication from when the opt-out is registered versus when it actually is honored. I think there's great technological solutions out there that are well established in the industry that should be able to be applied by any person in the debt collection business. The second comment is really just something to consider as rulemaking turns into actual policy and actually becomes the reg. Is there likely will be technological tools that are available to the consumer to help protect around harassment. A few analogies. Ad blocking is one of them, but also on Monday, Apple announced with iOS 13 that they're actually going to have capabilities to route spam calls and other types of calls directly to voicemail. So likely before this becomes a reg, there will be technological solutions out there that can prevent the consumer from being harassed in the meantime. So please keep that in mind.
So I want to comment a little bit on sort of the landscape of the lending market, which we see slowing down. And a lot of the loans, and we talked about this yesterday, a lot of the loans that have been originated in the last 5 years have been done under credit underwriting and risk algorithms that have not been fully tested under an economic recession. And the loan performance hasn't really been tested. So we know that lenders are starting to tighten their credit box. And so as borrowers are having to restructure, whether there's open-ended or closed-end loans, they're having a much more difficult time making that happen. And so more of these loans are now flowing through pipelines into collections departments. And I think we saw this back during the home crisis. Now you have collectors that are overburdened with accounts. In many cases, they don't have accurate information to have right party contacts. They have difficulty identifying, are the debts current? Have they been settled? And so I think that the ruling puts a lot of burden on the consumers to know what their rights are. And I think it would be good to have the Bureau understand how do you intend to educate these consumers and on their rights, and how do you expect to enforce violations of the consumer rights. Because we are seeing an increased volume of loans starting to get into first payment defaults and ultimately charging off.
Building on what Loz is saying and maybe offering a framework that's based on consumer empowerment, there's really 4 different pillars we think about. The first is visibility, being able to give that borrower relevant, timely information in a form that they can actually understand. And the internal metric that we use, I think everyone should use, is can the borrower now make a more well-informed decision? Because if you do that well, you can move over to the second pillar, which is control, which is really allowing the borrower to take back control over their debt and be able to tactically take actions that they might have not been able to do before, and effectively taking so much that might have been locked behind a phone call and bringing it to the forefront for them to be able to control. The third is flexibility. We talk about these loans, but a borrower might have a student loan or a mortgage for 20 or 30 years. The only thing you know to be true is their life is going to change for the better and the worse many times over. And the fact that this gets thought of as exception handling is just not the case. It really needs to be built into both the product and the service to allow flexibility, and that option should be given to them. Lastly is guidance. Them being able to get the support they need in the form they want it. Again, whether it's from a medium like text, chat, email, phone, or the most common thing is I tried to reach a human, and even though I got a human, I still got a robot, right? Being able to actually, okay, I'm not trying to self-serve anymore. I'm trying to have a conversation for problem solving, but the person on the other end is just running me through a script. So those are really the 4 kind of like pillars that I think in any rule making could be thought of in how to kind of really empower the borrower or the consumer in this case. Then on to the specific points in terms of the rulemaking, one on the number of calls being made a week. I think there's an opportunity to use data here to say, hey, is there actually even an increase in efficacy when you call a borrower more often or not? Or do you even get a decrease in engagement or a lack of then right party contact as a result of that? Because obviously the industry is always pushing, and even from a lender perspective, a lender will push a servicer to be like, well, my portfolio, you really need to call them 20 times. I know my folks, right? So there's an opportunity to make a case around what is even effective, let alone protective. From what we see internally, because we end up running this experiment each and every time, it's like, okay, for your portfolio, here, we're going to do an A/B test. We're going to show you what happens when you increase the number of calling them. But I think there's room to have more industry-wide research that then really helps educate both industry, but also kind of rulemaking. And then second, around, I think there's a really good point around using cell phone and text potentially as a unique identifier. It's very convenient for the borrower in most cases during working hours to want to be able to text back and forth with any provider, not necessarily even just a servicer, and being able to consider that a place where, okay, because again, at the end of the day, they are using that text or that phone to actually maybe sign into a lot of the products where you are showing them PII. So if they were using that for two-factor authentication, you should be able to use a text message right away to communicate with them. Thank you.
And I just wanted to, while I recognize that this is rulemaking for the debt collectors that one would believe we're trying to collect a legitimate debt and follow the rules and do it the right way, I know we're going to be talking a little bit about how our seniors are so taken advantage of. And so I hope there's special attention to the many aggressive, I'll use air quotes around debt collectors who, and that's why I mentioned that having to have proof of time-barred debt. My mother is in assisted living and has dementia. And I found in her mail that she was getting numerous letters about debt that had nothing to do with her or didn't exist. And she was already in a stressful place. So we know that there are, for every legitimate debt collector, I don't know how many illegitimate, but wanting to make sure if there's anything you can do with your rulemaking to particularly make it harder for aggressive debt collectors to repeatedly attempt to collect from our most vulnerable seniors.
Go ahead.
Comment, right on that topic. We were asked to consider new technologies, and for the growing population or a certain amount of population that will have dementia, diminished capacity, as well as those who are single or will become single over time, there may be new technologies or services that people can families can opt into and sign up for care of financial affairs during that process. And this predates death. You talk about deceased consumers in the proposed rule, but think about that other transition period where people do lose the capacity. There could be services developed that people opt into, pre-sign up, and set parameters on, almost like a trust type arrangement. And even there are attorneys specializing in overseeing trust arrangements called trust protectors. They deal a lot with firing investment managers, reviewing that, even in charitable areas looking at donor intent. But think about the intent of those who lose capacity to manage their financial affairs. They're still alive. Just have that as a consideration in your rule for new types of automation, especially for people of modest means or even great means, but they have to have a fiduciary-like third party in between them and what's going to happen to them. But what I'm suggesting is there may be services that will automate that because there's no family to do it, or perhaps the family is not trusted.
Thanks, Brent. I think that's a really interesting point, that connectivity basically starts earlier in life now and basically remains with you much, much later than say, the days of 1977 with just a landline. Thank you.
we had a list of comments from James, and so I'd like to ask again if there are further comments from either the CUAC or the CBAC on this issue.
Following up in response to what some of the comments were, going back to the 7 days and one call, I would suggest it needs to be clarified further. For example, if you get somebody, I think that was mentioned, going out the door and they say, call me back, is that a contact or is that not a contact? Or if they say, I want to come in and talk to you, do we have to say we have to wait a week to see them? I mean, it doesn't make a lot of sense to us. The other thing is, what about artificial intelligence? It mentions voicemail and text not counting, but what about chatbots and that kind of thing? Is that included? So we think very clear guidelines, because there's always attorneys out there looking for some kind of compliance violation, and to the extent we can make it clear, not only for the consumer, but for the industry, it'd be very helpful.
On that, I'd say thinking about it less likely about who's sending it and then the medium is sending it. So there is much more real-time or intrusive communications versus more async. So for example, phone clearly kind of falls into that, whereas in-app notifications or email, I think, don't fall in that, even though I saw that in the rulemaking. And where text, for example, is a little bit more of a gray area on how to think about that, especially as kind of Manning said, you do now have things where you can block these notifications or have them on do not disturb during times. So it's really thinking about the intrusiveness or the expectation of a real-time response on those communications rather than a human sent it maybe or an automated message kind of sent it.
There was just a question, I guess, raised by our group. I know at one point the Bureau had thought about making some of these provisions applicable to first parties, debt collectors like banks. And in fact, a lot of banks do follow the regulations just in spirit out of choice because they provide a good framework for collecting on debts. One of the questions we had was just the tie-in to Dodd-Frank and potentially the UDAP provisions, and there was an issue, just an item raised as to whether someone could say, even if the definition remains pretty standard with what was followed with third-party debt collectors, that the tie-ins with Dodd-Frank and UDAP, that those could potentially apply to first-party debt collectors. And I guess that was just something we were trying to make clear. And we had a similar question as to the 7-day time frame, and we raised an example of bank calling a consumer, talking to a consumer in regard to a specific debt where there was a follow-up made for a payment. We talk on a Monday, follow up for payment made on Wednesday, and payment doesn't come in on Wednesday. If it would apply, and if that UDAP potential could apply, could a bank even potentially be prevented from calling that consumer on Wednesday or Thursday just to see if there was an issue with the payment? I don't know if you have an immediate reaction on that, or if that's just something you'd want to make clear down the road.
Jeannie, I thank you for the question, certainly, and there are a lot of considerations here. I think specifically, as you noted, the FDCPA applies to third parties, and that is the intent of this rule. So we certainly recognize, though, the very concern you're raising as to what may happen or whether this does provide a framework that entities want to comply with just from again, a safe harbor standpoint. That is something that's in the back of our mind. I would say we're very explicit that the rule itself applies to third-party collection only.
You asked about, sorry, go ahead. You had asked about questions that we have, and I have one, and just we talked about for the most part the banks, and my bank included, we're first party, so we're not third party, so I'm not an expert on this. But when you're talking about the phone calls, one of the questions that I have is the phone almost becoming a hindrance on the collection effort? Because most people now, if you don't recognize the number, you don't pick up the phone. And then it seems that the trend now is people don't have voicemail, they've never set up their voicemail box, or they have one and it's maximum capacity and they just let it sit there, that it seems that the phone, and I know just internally talking with us as a first party collector, we have a very difficult time getting a hold of the person or even being able to leave a message. And just in a prior life that I had, that I worked closely with a collection company, and I spent a week listening to calls, and I was amazed at how hard it was to actually even be able to make a connection over the phone with the person. That, I was listening to calls and you would just hear beep, 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 the message, the mailbox has not been set up. So one of my questions is, how do you see the phone going forward? I mean, it makes sense that that's why we're going down
the text or the email, which of course then there's the hyperlink, and we're very sensitive about hitting a hyperlink because we can have other types of data security type issues. But first and foremost, it seems that phone was very prominent before, but where do you see that now?
Sure, and the Bureau is aware of concerns by industry in general about the sort of declining efficacy or perceived declining efficacy of outbound telephone calls. We're aware of specific robocalling softwares that industry claims are causing basically fewer calls to go through. In some cases, the caller may not be sure of the outcome of the call. They don't really know what the termination code was, so they don't know whether the consumer knew the call was landed or not. And then we're also aware in sort of an adjacent industry, which is more of the outbound telemarketers, that they've actually published some numbers talking about, I think, somewhere around 20 to 30% decline in efficacy of outbound calling. So it's an area we follow very closely.
Just if I could add, calling frequency is one of the higher categories of complaints that the Bureau receives. So while we are certainly aware of and tracking the developments in communication, and it's one of the reasons why the NPRM looks to address newer technologies, it is still, at least as of right now, one of the areas that we do hear a lot of consumer complaints about.
We're a first-party collector as well, so a lot of them don't apply, but we do occasionally send some of our charge-offs and things like that to collectors. And my concern a little bit is by the time we would send something to a third party, if it was an opt-in, as you're suggesting, I think, Sammy, you said that the information changes constantly, and by the time we as first party would turn something over, that opt-in is probably old, it's gone, there's no way they're going to be getting a hold of them. So I do like the protections for the consumer if they're being harassed on that, but I really think that having good protections allows to not have it be an opt-in, because they can take some steps to go backwards. Our biggest issue, and I think that's where this discussion gets sideways sometimes, is we all have that person in our mind of who is being harmed, or in our case, I'm frustrated I can't get a hold of my customer to help them. They won't answer the phone because they're either embarrassed or they don't want to talk. And if they just pick up the phone or answer an email, or if I get on social media and say, hey, can you at least talk to me about this? But when you look at a case like your mother, that's where I think we get sideways real quick.
Just Brian, quick follow-up question, because I'm curious, as when any of the first parties, when you get to that point that you transfer the debt to a third party, what's the communication to the consumer like at that point? And is that an opportunity when the consumer understands they're going to be hearing not from the bank, from a different collector, and at that point, maybe that's when that opt-in or opt-out conversation happens?
My answer to you would be that by the time I send something off to them, my only communication with the consumer is a return piece of mail, because I just can't get a hold of them. So it's done. There's no way I'm going to be able to get a hold of them.
Maybe to answer your question, from our institution's experience, we do let our members know that we're assigning out to collections, because they need to know that they are going to be working with a different party for the payments and arrangements with that. So they are notified at that time.
Would that then be an opportunity for that opt-in, opt-out conversation if you're making that direct handoff? About the types of communication that the vehicle.
Depending on, again, on how the different institutions handle that communication with the member. Sometimes ours is, I would say, it probably is not an ideal time for that opt-in conversation, because a lot of those that communication is in the form of a letter mailed to, and we're having difficulty connecting with them over the phone or through other means. So that letter is not going to give them that opportunity to respond back.
I echo what the folks are saying about the phone calls, just not being able to get a hold of somebody, and the letters. And maybe a point of clarity for the section about the communicating before credit reporting. If somebody does send out a letter and that letter comes back with an incorrect address, then what happens? What's the clarification on, can that then be sent into the credit bureau?
I had a comment to circle back to.
I was wondering if you were asking for an answer to your question, because if a letter does come back, then it's not Typically, what happens right now, even with validation notices, is that another letter would have to be sent. Now, that doesn't mean that if it doesn't come back, it doesn't always equate to it being delivered, reaching the right person, being opened and understood. So that is something that we keep in mind. But the case law under validation notices is that if they are returned, then it typically spurs another letter.
And that it could not be reported. The debt could not
Well,
be.
so at that point, you get into the question of whether the communication has been made. If your communication was through a letter, then you have not made the communication.
Okay.
And if I could slide a quick question in, when you send a letter to one of your consumers that you're placing it with the collection agency, do you actually let them know what collection agency to expect a call or a letter from?
This is if it's, in our case, we're first party, so it would be coming directly from the bank, but the customer just has not changed their address with us.
So I was more interested in the use of, say, goodbye letters from the creditor saying, hey, goodbye, you're now going to hear from Acme Debt Collector.
I will have to get back to you on the content specifically of that, but we will. Yeah.
Thanks.
We have 5 minutes left to this session, and so I just want to just give a 5-minute warning.
If I could go back, I had a comment on the call contacts, and then if you contact the consumer and then 7 days before you can contact them again, and just technologies that are available out there as it relates to calls. As the Bureau, I would recommend consider allowing for the potential for direct-to-voicemail messages to be left after a contact, especially if the Bureau is proposing safe harbor scripts or safe harbor disclosures within those voicemail contacts. That would allow for payment reminders, or if they had set up promises to pay with the debt collector, just to give them, again, an additional reminder. You said you'd pay by Friday, but allowing the contact to be a direct-to-voicemail could be a good alternative to a live phone call contact. So.
Okay, I thought I saw another light on this side, but no. Okay. Well, this has been very, very good, and one of the aspects of this discussion was to be able to have a response back and forth between consumers, the credit union, and the banks. I think that part of the reason why we're here is not only to state our comments or recommendations, but also to hear the other side and then respond with ways that might make some sense so that you can actually get a double coincidence of want. And so I truly appreciate what has been done at this time. And so if there are no other comments, we are going to get ready to roll into the next session. I want to again thank John and Kristen for engaging us and also informing us. Thank you. Thank you, and we're back and we're focused on the second topic, which involves the education and engagement of consumers. Interestingly, in this session, we have essentially a full basketball team, which suggests that it is an area of great importance to the CFPB because they have considerable resources represented in this space. We are joined today by Janaki Ratcliffe, who is the Assistant Director for the Office of Financial Education. We're also joined by Irene Shariki, who is the Senior Financial Education Program Analyst for the Office of Financial Education, and Gail Hillebrand, who is the Associate Director for Education and Engagement of Consumer Education and Engagement. Michael Herndon, who is the Deputy Assistant Director of the Office of Older Americans, and Judith Ricks, who is an economist in the Office of Research. I thank all of you for being here, and I turn it over to the team.
Okay, thank you, Dr. Johnson. I guess I will kick off first. I'm Yannicka Ratcliffe, Office of Financial Education. I met with both of the Community Bank Advisory Council and the Credit Union Advisory Council yesterday, so it's good to also be talking to the CAB members today. For some of you, this will be a little bit of a repeat between what Irene and I are sharing, but we will talk about the Director Start Small Save Up initiative, but we really also wanted to introduce in a more focused way the newest research we have on how financial education can make a difference on people's financial well-being. So that is our topic for today. I wanted to spend a minute before I turn it over to Irene to talk about this idea of financial well-being. Our question in the Office of Financial Education has been, our challenge has been to really try to understand how it is that the time and money spent on giving people financial education is well spent and actually makes a difference in their financial lives. And across a range of different ways of helping people save or improve their credit or do bankruptcy education or save for retirement, a whole host of things, a universal theme is that it all helps to improve their financial well-being. And what we really wanted to do was understand not what financial well-being means to me, but what financial well-being means to people out there in their real lives, and to connect things around financial education and financial behaviors to what really has meaning and value in their day-to-day lives. So we went to them and we asked, what does it mean to feel financial well-being? And we got this definition, which is both universal but also highly personal. And it involves these elements of having a sense of financial security and financial freedom of choice in the current moment through things like having control over your day-to-day finances or being able to make the kind of decisions that make life fun, enjoyable, have quality of life. And then when you look at the future, feeling secure that you could deal with a financial shock and feeling like you're on track with those long-term life/financial goals, be it retirement, be it education, be it home ownership, et cetera. So this is the definition of financial well-being that undergirds so much of our work in financial education. It undergirds the Start Small Save Up initiative, which we'll touch and talk about how they relate. And it undergirds even the things we're trying to do with youth financial education and with financial education across the life cycle. So Irene is going to talk about the latest research that we just released this year on how financial education can make a difference in people's financial well-being.
Great, thank you, Yannicka. And we specialize in having hard-to-pronounce names here in Office of Financial Education. We gave you a run for your money there, Dr. Johnson. Sorry about that. So once we came up with this definition, which was a few years ago, the question is, well, that's great, but then how do you measure it? How do you know if you are succeeding in helping someone improve their financial well-being? So we did a research project to develop a financial well-being scale. Scale is a set of questions that leads to a single number at the end, similar to like the SAT. We came up with this scale of 10 questions. It was rigorously tested, evaluated across thousands of people to be a way, again, to get at what Yannicka said of measuring a kind of a single concept, but that's customized and unique to each person, but then can be compared across people. And so the scale is 10 questions. They kind of deceptively simple in a way. I'm securing my financial future. I'm just getting by financially. I have money left over at the end of the month. But they're each measuring a different aspect of those four boxes that Yannicka put up. We put this scale out. When you take this, you get a score between 0 and 100. And just so you know, it's set so that 50 is around the midpoint. It's not an academic scale where 80 is passing. And because people will sometimes get an 80 and say, I didn't do that well. And like, actually, you have to be doing really well to get an 80. And so then once we had this scale, we wanted to better understand what does it mean? What are Americans finding in terms of their scale, in terms of their financial well-being, and have a better sense of the lay of the land. So, and in order to help people to use this scale, we have a web page, Find Out Your Financial Wellbeing, where you can take that quiz online and it will pop up your score on a pretty colored band there to let you see where you stand relative to the national average. And it will also allow you to get comparisons. I think that's one more push. Let's see. Yes. Comparisons based on others of the same age or same employment status. You're comparing yourself to others. And then it also links to our different tools and resources to help you, in fact, improve your well-being if there's particular areas you want to work on. So that's on our website. It's been accessed quite extensively by the public. But again, we wanted to know what's the state of financial well-being in America. And so again, some of you may have heard about this, but we did a survey to better understand, a nationally representative survey. And we found the average was around 54, which is what we expected. And we did some more analysis to better understand what a good versus, bigger is better in this case, but what a good score versus a less good score is, and where there's break points where increasing your score has a significant impact on your overall kind of sense of financial wellness and other financial circumstances. And so we have these sort of quirky bands of 0 to 29, 30 to 37, et cetera, from very low to very high. Underneath it are the percentages. You can see that about a third of Americans are kind of in the middle, especially if you look at kind of the 50 to 60 kind of more stylized band in a way. About a third of Americans are kind of in the low to very low, and about a third in the high to very high, approximately. And then just so you can see how this reflects real-life financial experiences, people who have a very low score, 82% of them can't come up with less than $500 in liquid savings. Up in the high range, very high range, only 2% are unable to or don't have $500. And similarly with difficulty to cover expenses. So you can see that, people do much better when they have a higher well-being score, which is exactly what we would expect. We were hoping that this, in fact, is meaningful. People are reporting on that their well-being actually corresponds to meaningful financial circumstance. So this was all the background. We had all this data. We wanted to understand, okay, so what can we learn from this about what actually impacts financial well-being? How do you improve it? What can financial education do? And so we took this data, which was descriptive, and actually did some analysis. We controlled for income. We controlled for other factors we could see in order to come up with a sense of, again, what's kind of impacting what's correlating with what. The secret is going to be revealed in this line here, which is that financial skill is a key part of that pathway. Though I will lead you to that story, but we kind of gave away the punchline here. There were a bunch of different things we looked at in terms of understanding what are the drivers of financial well-being, financial knowledge, attitudes, behavior, skill, financial situation. I don't know if any of you had this, but when I was a child, I had a plastic cog toy that looked just like this. And you could move the cogs and you turn one. I spent hours playing with it. So I feel like, did anyone else have that as a kid? Yeah, I'm seeing some nods. So I feel like I discovered the key to financial well-being when I was 4. Yeah. I just didn't know what the labels were. But I love this diagram for that reason. It brings me back to my childhood. So the answer is this. Here we go. We're done now. This is the answer. I like to show this slide because for any of you in the room who are researchers, this is actually the model with the coefficients and the kind of equations and all the, the significance levels. Obviously, it's not exactly clear to really almost anyone unless you are. So we have a simplified version, but this is just to show we actually did something called structural equation modeling, which I have a faint sense of what that means, but it's a way to understand the relationships between different factors. So the next diagram, for a minute, don't look at the blue lines, but this is the simple version. Again, ignore the blue box. Financial skill leads to financial behavior, leads to financial situation, leads to financial well-being. I'll say a little bit more about each of those. Looking at the final piece, financial situation is strongly associated with financial well-being. That sounds obvious, but remember here, we're controlling for income. It's not just you have more money, you're better off. If you control for income, people with a better objective financial situation are doing better. And by objective financial situation, we mean some measures around hardship, around negative experiences with credit and debt, having trouble paying expenses. So ways to look at your and liquid savings is included there as well. So it's looking at your financial situation, holding income constant. And that is highly linked to financial well-being, which is good. If it wasn't, you could say people are just answering whatever they want to these questions and it's not related to reality. But in fact, it is highly correlated. And so that's part of the pathway. Well then, what impacts people's financial situation. And clearly, you can guess because the next box is financial behavior. Now the blue box will move. Financial behavior is strongly associated with financial situation. And we had a list of a number of behaviors we looked at. Specifically, if I can get this to move, these are some of the financial behaviors that were highly linked or correlated with financial situation and therefore financial well-being. Again, these won't surprise you, around money management, propensity to plan, and savings habit. Things like paying bills on time, staying within budget, checking your statements, bills, and receipts for errors, following through on your financial commitments, sticking to a budget, consulting your budget to guide spending. So these types of behaviors, again, it sort of makes sense when you think about it, will lead to a better financial situation, leading to more financial well-being. Now we're going to go one step further to the left to understand what is the most strong association with financial behavior. And here we're looking at things like knowledge and other things. And surprise, surprise, since I gave it away earlier, the answer is financial skill. It was most strongly associated with financial behavior, more strongly than financial knowledge. Now, again, skill and knowledge are interactive. There's a kind of a cycle there. As you do more, you know more, and vice versa. But if you hold all things constant, financial skill is extremely important. Financial self-confidence was as well, financial self-efficacy. And again, there's a kind of a feedback loop amongst all those things. So what do we mean by financial skill? Let's see if whoops, I'm sorry, I just pointed the laser pointer at you. That was the wrong button. I wondered why I was seeing a red flashing light over your head. So financial skill, the way we defined it, is knowing how to find reliable information to make decisions, knowing how to process that information to make a decision, and then how to execute or implement those decisions. And if you think about it, it makes sense. You don't need to know everything about mortgage rates, what's the mortgage rate, how have they changed over time, things like that. You need to know how to find a trusted source, know what information you need to get it, use it, figure out how it applies to you. And so financial skill is it's a type of knowledge in a way. And we do think it is something that can be taught. You can take financial education classes and have them emphasize more the skill portion. How do you help people find the information they need and use it? And so that is really a key now foundation, I think, going forward for our financial education efforts. At least I hope it is. Whoops, that was the laser pointer again. The way we measured it, we actually have a scale. Again, we love scales, another 10-question scale. Again, these are self-reported skills, but we find people actually are fairly good about reporting this sort of thing. This scale is also available. Both the scales I've shown are available for the public, for financial educators, for industry, anybody who wants to use it. We have resources to help people use these things. And so the skill scale, again, is similarly, I know how to make financial decisions that are good for me. I know how to follow through on intentions. I know how to make myself save. I know when I need advice about money. Things like that is our financial skill scale. And so lastly, here's the model without the blue boxes, basically this pathway to financial well-being. And it really suggests that financial education can help consumers, especially by working around that financial skill piece. And again, many other things one can do, but financial skill is one way to kind of organize how existing financial education is done. We can kind of convert to focusing on the skill part of that equation, I think, fairly easily. And quite a few of the Bureau's tools and resources do that, in fact. And this is just kind of reiterating that. So now I'm going to turn it over to Janneke to talk about how that applies to other things.
So I guess, my sense is when we talk about financial skill as a pathway to financial well-being and that these behaviors matter, it's does not feel revolutionary. Maybe it even feels obvious. But the fact that it's so obvious is innovative in the field of financial education, where a lot of work has been done around trying to fill people's heads with a lot of general content and knowledge and concepts, and there hasn't been as much emphasis on this skill piece and on this behavior-based focus. So it is refreshing in that it helps people focus on skill and which skills, and it helps educators focus on behaviors and which behaviors. So we'll just try to operationalize that by talking about our savings initiative and talk about how we're taking a skill-based and behavior-based approach to that. In the research we did, we found that the amount of liquid savings a person has is very highly related to their financial well-being score, and that even small amounts make a big difference or associated with a big difference. So people who have virtually no liquid savings have an average financial well-being score of 41. If they just go up another jump to $250 to $500 range, it's a big step up. If they go over 1,000, you see another step up to 52 as an average. So it seems to be a place to focus for helping people build financial well-being. And here is again the model Irene showed us, and to just operationalize that for Start Small, Save Up, the Director of Savings Initiative. The research showed that how much you have saved is one of the very important factors in the objective financial situation correlated to your sense of financial well-being, which is not surprising because you saw how being able to weather a financial shock is an important part of someone's sense of financial well-being. So that fits. And we found that when we looked at the behaviors, as you perhaps noticed, reporting having a regular savings habit was correlated with actually having more savings. And when we asked them about things they knew how to do, people who reported knowing how to save were much more likely to have a savings habit. So the implication is that perhaps by teaching people the skills and the how-to around savings, you will see the development and also building the confidence piece. Then you'll see the development of this savings habit, and then that will impact the amount saved and ultimately the financial well-being. And I feel like yesterday we had some good conversations with members of the CUAC and CBAC around, for example, how to help people build that skill through account features that sort of get them started and then help them build that habit. I felt like we had a lot of conversation that focused on the importance of really that habit. So thanks for that conversation yesterday. For the Bureau's own resources, we're talking about these sort of three elements of starting small, which is a good way to build a habit. It's not that hard to begin saving if you can start putting aside small amounts. To plan for the unexpected as a framework, since that relates so much to people's motivation and their sense of financial well-being. And then we have heard a lot about the value of automaticity in helping to reinforce that savings habit. So that leads us to some discussion questions and some discussion opportunity. Dr. Johnson, you can take it from here.
Okay, thank you. Actually, I did want to start out with a couple of quick questions. We only have really 10 minutes because we have one other presentation. But just in terms of the formulation of the measures, one, I would offer that the next stage should really consider something like a transition probability matrix, because presumption here is that the people are not saving and they're not doing, but it could just be that they have a volatility of employment. Someone is ill, and so they were saving, but now they're in a situation, and so a transition matrix, just similar to what Moody's and the rest of them do. They have AAA, and then the AAA company can actually wind up being junk. Is something that I would suggest you look at, because that gets rid of the unidirectional element. And then the other point that I would like to make is that your Z-score that you're effectively generating, or those categories that you're generating, are being generated based on cross-sectional information. Again, back to that notion of transition, you may also want to look at longitudinal. And so with that, the direct questions that are before us, I'd love to open it up. Brent?
I'll do some great work here. We at the National Endowment have been evolving to this DECIDE model about decision making. We have something called mindful money management behaviors. People consider consequences of their actions, willing to accept responsibility, and based on their values. Another issue is clutter. I've given a few keynotes on something called financial stacking, this inability to decide or make choice, but giving people a formula to align what they see, set aside, and focus. and then learn and repeat from that. So it is actually this choice decision-making matrix. Sheena Iyengar, a great behavioral economist who invented the JAM test, talks about too much choice sometimes, and choice is a bet on the future. So teaching these principles, absent of specific techniques, build a sense of momentum and resiliency to tackle emerging issues and new things. And then real quick comment on the savings. Liquid savings is kind of a fulcrum for life that you can build on, emergency savings. So we're suggesting to the Bureau 7 action ideas to build on this important initiative. I'll run them by real fast. Emergency savings as sidecar with retirement is one. Emergency savings is a supplementary complementary with a loan product. Prize linked. Emergency savings is debt mitigation alternative. Basically, if you have liquid savings, you have an antidote to payday lending, and to kind of get that message out. It's a educational sweet spot in the governmental, private sector, nonprofit space of financial education with the Financial Literacy Education Commission. This can be a hallmark of having the different agencies, and our director serves as vice chair of the FLEC, and they're undergoing a FLEC reform initiative. Savings bond is number 6, and number 5, just the issue that the Bureau can have to help people navigate the historical name cluttering, Roth, 401k, 403b, savings, but all that to show graphically kind of a pathway for them in savings.
Well, thank you all, and I know that you know how much I appreciate your resources, and we use them a lot in Georgia, and the fact that you make them available in great quantities. We appreciate being able to adapt various curriculum when we do train the trainer workshops to get direct to community. Those continue to be very helpful. Pleased that we're getting the latest Money Smart curriculum update in Georgia as we're working to launch Bank on Atlanta. But one of the things that we find in all the ways that we try to help consumers is the one-stop shop approach is the most effective. For example, we make sure that some of this information is put in a video type form or a PowerPoint that can repeat, that we distribute to community action agencies. People are already going there for help, paying their power bills or other forms of assistance. So the more you all can think about ways to go to the consumer where they're already going to get services that they need. I certainly appreciate your documentation of the challenges faced by people who are liquid asset poor. And we know that is really ultimately, in my experience, the greatest challenge to ultimate financial well-being. And as I always will do when we're having these conversations, remind everyone that liquid asset poverty is particularly prevalent in communities of color. Decades, hundreds of years of structural racism in the country have led Black families not to have a home that they can rely on to get a loan to pay for school, not to be able to pass on to their children. So as you're thinking about and designing resources specifically to help consumers experiencing liquid asset poverty, make sure that you're working with, again, with the one-stop shop approach, with partners working in communities of color to make sure that these messages, and it would be great if people could save $300 or $400, but if you're living paycheck to paycheck and you don't have anything for collateral, or even worse, the only form of collateral you have is your car, and you take out a car title loan and you're paying 300% interest or more, you're never going to get out of that poverty situation. So again, I appreciate your all the work that you're doing. It's amazing, and just doing a little bit more to get right to where consumers are already going for help.
Yannicka and
We have time for one more.
So,
go ahead.
So I was going to say the financial well-being questionnaire is excellent, and the part that's particularly great is the benchmarking to people of similar age and income levels. Like Liz was saying, what we have found is that the best combination is when you're offering the product and then offering that technical advice or assistance, because that's really what drives permanent and lasting change in the lives of individuals to help them earn, save, invest in their futures. I think that, something that the Bureau could consider was to match product utilization and not just simply with the educational materials, things like incentivized savings accounts, school-based account, credit-building products, and other products where both can come together.
And I would just like to kind of jump on what Luz was saying, and thank you guys so much. I mean, this is a subject that's near and dear to my heart. Also, the company that I'm proud to represent, Acorns, actually does this every single day. This is our business. We believe deeply in education. It's embedded in everything that we do. And I really like the model that you guys have built, just because I think, if I bring it to specifically how we do it at Acorns, actually the skill itself is actually becoming a customer. The behavior that it gets established is really that habit, is the way in which we use automation to drive that good, positive behavior. And I think one of the things that I would encourage everybody to continue to try to incorporate here is we have a tendency to approach this from a very rational point of view, and this is stubbornly emotional. And so the confidence and the optimism as someone has a low score and moves kind of up the chain, I think is incredibly important. And so, from our perspective, education isn't a top of the funnel messaging strategy that then turns into, kind of this disparate thing that happens with, then I need to action that with a product. I think what you have to do is you have to integrate that. And I think CFSI has started to really, the Financial Health Network, sorry, they've rebranded, but have really kind of come to that conclusion themselves as well, and really trying to become more product oriented, because I think that's actually the way to make impact. Because the issue with financial education is not about content, it's about the ability to drive action and build confidence. So thank you very much.
Okay, well, we're ready to take on the next part of this session, and we'll begin with Gil Hillebrand.
Thank you, Dr. Johnson. You referenced the size of our team. That's because it takes 3 of us to replace the incomparable Naomi Karp, who was going to speak today. I'm going to give her presentation. I'm joined by Michael Herndon, who will be able to answer questions about this work and other work of the Office for the Financial Protection of Older Americans, and by Judith Ricks, in case you have any methodological questions. She was one of our partners in the Office of Research here at the Bureau. So we're going to talk about suspicious activity reports and what we have learned about financial exploitation of elders from those reports. I don't need to tell bankers in the room what a SAR is. You file them, you know what those are. What we wanted to know is what could we learn from those SARs, which since 2013 have had a box where you can identify, we think this is suspected or actual elder financial exploitation. What could we learn about this crime against elders from these reports? By and large, you, the filers, can't see these reports. Your local law enforcement can see them, and we can see them as a regulator. So that's why we did this study. Here's what we saw. FinCEN reports can tell us something about what's happening. They can identify transactional red flags, things like frequent large withdrawals, uncharacteristic timing of withdrawals. If you are 80 and suddenly your ATM card's being used at midnight somewhere, and that never happened before, there's an alert, right? They also include some behavioral red flags. This often is a teller observation that the senior is with a person who appears to be not allowing them to participate in the transaction, and sometimes some other behavioral red flags. Since we've had this information now collected in electronic form since April of 2013, we were able to look at both the structured data and also the narratives that filers file describing both the actual fraud and the attempted fraud. So here's the study. Over 180,000 structured data where you and your colleagues around the country checked the box that said elder financial exploitation. And then we did a random sample, and we pulled out just over 1,000 actual reports and looked at what those narratives did. We had a 5-person team with research on older Americans that coded those, so we could look at things like age, type of fraud, was it stranger fraud or someone known to the consumer? The checkboxes don't go beyond whether that's caregiver or son-in-law or grandchild, but they do say known to the consumer. We did some cross-matching to make sure that the random samples seemed to be telling us the same thing that the structured data was telling us. And then I'm going to tell you some of what we found. SARS filings are up for elder financial exploitation. They were up 4x over the period from 2013 to 2017. Regular SARS filings increased about 40% over that same time. So they're up a lot. They were up about 2x for depository institutions, and that suggests that the money services businesses who also report are beginning to report at a higher rate. And you'll also see that in the picture here, where you see money services businesses having an increasing share of the elder financial exploitation SARS. Now, it's bad news we still have this fraud. I'm still on the last slide, thank you. It's bad news we still have this fraud. It's good news that more people are reporting. But this is only reporting to FinCEN through the SARS process. This does not include reporting to local adult protective services or local law enforcement. And I'm going to talk a little bit later about how important that is and what we can do there. And this does not mean that the share of fraud is changing. This means the share of reports are changing. We know this is a deeply underreported crime. So this doesn't tell us that it's going down for depository institutions and up for money services. It only tells us the share of reporting is changing. Just in 2017 alone, financial institutions reported $1.7 billion in suspicious activities. Unfortunately, across all of these reports, 80% showed an actual dollar loss. Since it covers attempts, some of them were, we saw this, we stopped it, and so that other 20% is not a loss to either the business or the consumer. We did also see that there were losses to financial institutions as well as to consumers, although most of the loss was on the consumer side. And as you see right at the last bar chart here, the total amount being lost to elders is still higher from the depository accounts than from the money services businesses. That's because your account is where your money is. At least that's what we think. So monetary losses are common and substantial. As I mentioned, 80% had a loss. Older adults had an average loss of just over $34,000. If it was, and filers had a loss of almost $17,000, $16,700. And that will be a case where the filer stopped the transaction after it started and chose to incur the loss. Also, 9% of the SARS were on credit cards, and as you know, that loss is less likely to fall on the individual than on someone else in the system, including the filer. 1/3 of all the individuals who were reported to have lost money were over age 80. Just think for a moment how hard it is to earn that money back at that stage in your life. And the losses were greater, substantially greater, when the person who perpetrated the loss was known to the consumer, more than twice. We also found, and it's not on the slide, but it's in the report, the average duration of these losses, the pattern of activity that led to the loss was 120 days. And that's where I want to come to early reporting. So the good news, people are reporting to SARS. The good news, a lot of communities are creating elder financial protection and prevention networks to try to prevent and respond to this. Michael's office and the Bureau is here to help folks do that. The bad news that we found here is 28% of all reporters checked the box that said, we also told either the local adult protective services or the local law enforcement about this. 28%. For those of you in depository institutions in the room and listening in, you were at 52%. Money services businesses were at 1%. Now, more of their reports were about stranger fraud. So there is also the question of, if you get the same Nigerian scam again and again, how many times do you report it? Nonetheless, that suggests there's a lot of room for opportunity to improve there in terms of reporting, both for depository institutions and for money services businesses. And we found that most who did report were reporting to adult protective services. Only 7% of those who checked the reporting box said, I reported it to local law enforcement. Now think about that 120-day pattern. The sooner local law enforcement hears, the better shot they have at stopping it for your customer and for the next customer and the next customer. So when we look at the implications of this report, we know that elder financial abuse is still widespread. We know it's very damaging, particularly at an age and stage in life where you can't make that money up. We know that financial institutions of all types are filing more SARS, and that's very positive, but they are not indicating that reporting is also going to local law enforcement and local adult protective services. And we think that's a real opportunity to strengthen prevention and response here. And we also know that local law enforcement have access to these reports, and some are using them and many are not. So in terms of additional implications, it's mostly stranger for money services businesses. It seems to be mostly known people for depository institution. That means the responses will be different. For money services businesses, in the report, we say the response might be a really big warning and some very good protocol training for the employees to make sure that whatever anti-fraud protocols are in place are being followed every day, every time. For those on the depository institution side, it may be more about alerts. It may be about pattern monitoring to recognize these trends. And for those of you who are in states where you are allowed to place a hold on a suspicious transaction, we identified 4 states that permit that by law. That can be a really valuable tool in making sure that something gets looked into before the money goes out the door. Finally, before we go to questions and discussion, if there's anyone watching the live stream who is currently aware of a potential elder abuse situation, whether it's physical or financial, you can find your local adult protective services by calling the Federal Elder Care Locator at 1-800-677-1116. That's provided by the Administration for Community Living, not by the Bureau, but very important. If you see something, say something. And I would be delighted to take some questions.
Okay, we are invited to comment. One, thank you. This has really been quite informative to me in terms of the level of challenge and but also the work that the Bureau is doing.
So one question I have is, and I think this is going to be perhaps state by state, but understanding what laws are in place to require reporting of elder abuse. You know, there are certain laws in place to require, teachers to report suspected child abuse. So what is the Bureau able to do in that space? And then not only requiring reporting to law enforcement, but anything that's being done in some states to require law enforcement to act rapidly, particularly in the case of potential clusters of abuse.
It does vary greatly from state to state. Some, like you said, some states it's anyone. If you suspect a problem, it's clergy and those other areas. What we've been doing is trying to show recommendations as opposed to saying specifically in each state or each local community what the protocol should be or what their law should be, is to say here are examples, here are models to follow, and trying to show at the same time what are the effects of that, because it's going to be better if we have some sort of evidence and can provide, say, this is what, in this state, this particular example worked, or in this community. I think a lot of the times, the community is where it needs to be addressed more closely. And I mean, almost a micro community. Are healthcare providers aware and how to report? They see some physical abuse possibly.
Right.
So it's not just a bank teller, it's going to be a pastor, a healthcare provider, neighbors in all kinds of places. So we're trying to really work on building those collaboration and cross-communication channels at the very local level that then can be supported by a bit higher level policy.
If you have those examples of, best practice or good practice protocols that in a shareable format, I'd love to be able to see that.
Yeah, we do. We're working on a lot of things within that network space as well. The Department of Justice, who we've been coordinating with in their Elder Justice Initiative, have some good examples of particular local communities and what they've done on a variety of those elder financial and fraud prevention efforts. So we can work with you to get you all of that.
One thing you can see on this right now on our website is a pair of reports on elder financial protection. We keep changing the acronym, but it's Prevention and Response Networks. We did a study with Library of Congress documenting the value of those networks around 2016. More recently, we have issued a report on some convenings we're holding. What we are trying to do is make ourselves available to go to a local area and introduce the players to each other. So if law enforcement and bankers and credit union leaders and adult protective services get to know each other, they almost always want to work together, but it's that first step of coming together around this issue.
Yeah, thank you, Gail and Michael. That's very helpful, and I agree with you in terms of the community approach, because I think you're more likely to bring those parties together. There's a National Identity Theft Victims Assistance Network that also brings those same parties together. We're at one of the states that's a member of that network, and so perhaps we can talk later about sharing strategies.
Great.
Thank you.
Dr. Johnson, you mentioned 4 states that had passed some legislation. Tennessee was one that recently passed some legislation from the Tennessee Bankers Association to give the bankers safe haven, for lack of a better way to say, to stop transactions without liability. It's moving forward, and it's I think, a good proactive way for banks to work with their states to be able to give themselves some protection so that they can intervene in these transactions. And so that model legislation's out there and is in effect in Tennessee. Department of Financial Institutions, Greg Gonzalez was very much behind that as well. So there are ways that I think we can move this forward, but it's a big issue.
I don't know if there's a way to connect this space with the Save Up initiative, but grandparents are often the de facto emergency fund for their family. They have the financial ballast that actually upholds communities in many ways through equity in the home and just frugality and, and just staying with it and for the best intent of their family. This issue of decumulation of retirement paycheck, and we've developed a website called My Retirement Paycheck to look at this issue holistically. So fraud and debt of the 7 or 8 key areas are 2 of those considerations, because you can, instead of a spend down mode, you could end up with a steal down mode, as you've implied. And it's just, it's non-recoverable, and there aren't other alternate grandparents to bail out the grandparents that lost it. So it's just a big area for society as we age. But this type of networking of the Bureau with state and local officials that the director mentioned earlier, this can bring up synergies and imaginary, interesting ideas from the field that will get this into common language. Michael, you mentioned those other key interveners on the local level, and if they have this as top of mind, it's really good. So just applaud this effort, and local district attorneys are very involved in this as well. So thank you.
I have a question for the Bureau related to just, are there plans to tailor resources to local APS agents to help provide consistency in the investigations that they do? The APS agents that we work with are doing great work. We've just seen a handful of instances where there may not have been consistency in what we felt the investigation process that caused us to have to do later reporting and re-report to APS agents. So what's the Bureau's plan for that?
Are you saying to provide the APS workers models on case review and those kinds of things?
Exactly. Yep.
We've been working on trying to come up with resources to help the collaboration between all of those areas, and highlighting where we can, again, examples of positive examples in other places, as opposed to coming up with a real specific set of protocols from ourselves. It's more of highlighting what others have done. And again, I would refer to the Department of Justice, and one of the reasons we're not going too heavily into it is because we saw what did justice do and what can we do to complement it and collaborate closely with them. So within their multidisciplinary team website, they have some examples of how to do that.
One of the things that I'd like to just comment on is some of your statistics. You didn't say this, but I kind of heard that you'd like us to, as bankers, to be able to report that to local law enforcement more and to the vulnerable adults. But I got to tell you that, or to the agencies, I think there's 2 types, at least for us, there's 2 types of vulnerabilities. There's some that people are just, they got scammed.
Yeah.
And that happens. They're embarrassed. They don't want to talk to anybody about it. In our judgment, they don't need any help. It's one and done, and we then aren't going to waste people's time by moving that forward. There's others that, in one particular case, I had a customer that came in 3 different months, and it was to the point where we did try to get a hold of some people, some of the family members, and then we did contact the services. So I wouldn't let your numbers skew the fact that that's not being done. I think that we as bankers do know our local law enforcement, and we do know our local county and all the workers, and I think appropriately send that information when we need help. The other thing is our bank just held, as I'm sure most in the room have done, we just held a seminar talking about some of the scams. And when we use certain words like the elder abuse, that really infuriates them. It's like calling them millennials that they don't, they're all being lumped into one section or one stereotype. And so we're seeing it not only with the older generation, but with some of the new scams that are coming out that are much younger. And I think you're going to see more and more of that. So I'd be a little cautious that we're only focusing on elder, although I see that you have the statistics that it's really happening there. So those are my comments.
Thank you. That's very helpful. And of course, to do work for elder Americans, you have to be thinking about the caregiver generation, and also what I like to think of as the pre-old, which are folks who are working right now but need to plan for later financial life security. And that's both what you save and how you invest and how you manage your money, but also making sure it isn't stolen from you or from those who you will have to support if it is stolen from them.
Now, I'll add some of my background has been in different types of fraud, and that some studies have said that fraud is not an issue of age. It's everyone's susceptible to fraud. It's the type of fraud that typically happens to you. If you're in your 20s, you're probably not going to fall victim to a Ponzi scheme because you don't have anything to invest. So Ponzi schemes are going to skew to older people, but you may be falling for online kind of scams, purchases on the internet. So we're pretty aware of how to talk to certain audiences, and we're constantly looking at what terms should we use, what's the tone in our materials, do we talk about an experienced financial consumer, or do we talk about an older American? So we're trying to be very cognizant of that.
Thank you. In San Diego, very focused on this. We've taken the approach of educating members and employees, and we've seen a decrease in the number of reportings that we've had to do as a result of that, which we believe is preventative. But on the other side, Adult Protective Services, we serve 3 counties. 2 of the 3 are really good about it. 1 county's not all that interested, which is sad. But on the other side, we also don't get back reports. So after we report, then we'd like to better manage the accounts if something was validated, but we don't get that information back. So we don't know if there's any way to influence them to be more sharing back to the organization so we can better protect our clients as well.
That's very helpful to know. If you would like to share with us on any kind of a public or confidential basis the educational material that's working, we'd love to see that.
I've got one other brief question. Do you all get involved in uniform state laws? I know there's this thing called USASLI, the Uniform State Law Group, but on some of these elder fraud areas where best practice laws are discussed, like that might be a great forum to bring your research in front of people that kind of tee up ideas for state legislative action and through various administrators.
I will say, Brent, that certainly I know the Department of Justice is very involved in those efforts on a variety of fronts. I will let Gail note, at least if there's a particular instance where we've paid attention or where our expertise has been sought in those kinds of conversations. I'd say we're probably cognizant of, as we've talked in other forums too, the roles of the states there, but we are certainly at their disposal if there's something in particular that they wanted to explore that touches on our expertise. But are there any specific examples of where we maybe have had our expertise sought?
I don't think we've been asked in the state uniform law process, and as the director said, state law is state law, but we have an evidence base about this problem, and we share it with anyone and everyone who wants to attack this problem.
I'm curious to know, have you seen any, there's several states that passed laws, so Texas passed a law on this, but I think in 2017. Have you done a geographical analysis to see the efficacy of these laws in jurisdictions that have a law versus jurisdictions that don't have protection?
I'm familiar with a listing. It wasn't one that we created, but I do recall finding a list and sharing it with Naomi, who's not here today, to say, here's a lot of helpful information for when we are talking about this, to say, here's the variety of how it's different in each state, and then as well, kind of using it as an example. So I know that exists. It wasn't something that we created, but I know that resource exists.
If your question is, have we done a data analysis related to those states, many of those laws are quite new. That's a very interesting thing for us to consider going forward, but we haven't done it yet.
It would also be interesting to see if it triggers a higher maybe the reporting will actually increase. So does reporting increase in the states, or does actual fraud decrease?
Yeah, that's
So
very hard to
it'd
measure.
be interesting to try to tease that out. I'll leave it to your statisticians.
I would note, too, that's an area where I know OJP is paying attention. So there is at the Office of Justice Programs at DOJ, there is a presidential task force on elder fraud. I do forget what exactly the name of that task force is, but we've been an active participant in that effort. And there is, it's a great example, frankly, of a lot of interagency cooperation at the federal level, and then also with the states, because there are a lot of different equities and expertises that can be brought to bear on that particular question. So I imagine they are paying attention to that, but we can at least flag an interest in that kind of comparison or study.
I can also mention that in the process of doing this data analysis, because of the point at which the EFE SAR filing began, which was in 2013, there were only, I believe, 2, maybe 3 states that had these law changes. So in some of the preliminary analysis, we attempted to look over time at these law changes, but we didn't see any substantial increases or substantial effects associated with those state law changes, which is one of the reasons why we haven't included it in the published report. We feel that we need to extend that analysis a little further, gain a little more data over time, and potentially see some more changes across other states.
I can share qualitatively, when the law went in effect in our institution, we implemented training across the institution, and we've stopped a number of instances because of the law and the protections it gives us. So, but I can't give you a statistical reference for that.
I had kind of a comment question, and you had mentioned what you're seeing at banks, and we're one that does this as far as our BSA AML monitoring software. We have components built into it looking for elder abuse or financial abuse. And I had a question in terms of a lot of it's dynamic where we have the ability to modify parameters and things like that. But I was wondering, has there been conversations between the Bureau and some of the larger providers that community banks use in terms of, are the suggested parameters that they have set, are they hitting the mark? Are there new trends that you're seeing that maybe need to be factored into some of these programs that we're using?
I'm not familiar with any analysis that's deep enough to say is the trends we're seeing that came from any reports or even just sort of anecdotally to set parameters within that. Ours tend to be a little bit broader about the possibilities of the recommendations we've given financial institutions about using technology. I would like to, and we were thinking about doing more work in that area to be able to provide more specifics and provide some of the evidence. And again, it's such a fluid thing, especially when it's elder abuse, because a lot of times it's family members, and that gets kind of blurry. Is the person, they're the power of attorney, but are they abusing that? And does the bank really understand that? So versus somebody broke in your house and stole a TV, that's a pretty clear cut and dry kind of thing to monitor and report and analyze versus the fluidity that we see in a lot of elder abuse.
Right. Yeah. No, I understand. And definitely, there's the front line. Just the behavior and things like that. Obviously, that goes into it, and that could be much more of a sign. But I was just wondering, as there's been more data has been collected, and unfortunately, as there's more scenarios, can we use that data? And I do recognize that schemes and things like that can change over time. So something that was being used a year ago might not be relevant this year. But I was just seeing that maybe that interaction between the system providers and the results that you're seeing, could that help build even more robust systems?
We'll follow up with you on those systems providers because we'd like to know more about what they are tracking for, because there may be some work to be done there. Thank you.
If we think about this in terms of faster payment systems, this is also another reason to make sure that it's not final, instantaneous, credited, you can't take it back, because at the time we go to look at something, if we can't get it back for the elder, their whole life savings can be gone. So I think it ties together.
Are there any other comments or questions? Well, You want to do some wrap up?
Yes, thank you. I'd just like to highlight for you the consumerfinance.gov has our Older Americans page, which has all of the resources that we offer for individuals and for people who serve them. You will see there the participant guide for Money Smart for older adults. That's a joint project we have with the FDIC. Many of you give Money Smart trainings in your communities. There is one specifically for older adults focused on anti-fraud. We also offer there the managing someone else's money. That's for family members and others who are trying to do it right, but are not experienced financial professionals and want to know how to do it right. And those are available for co-branding. We just put that up, I believe, and also for download and print if you want to make them available to your customers. We also have a set of placemats for community meal service providers who can, if they're giving meals to the elderly, the placemat, most of them are anti-fraud messages, and sometimes on the back there's a game or something to reinforce the learning. And there are also some 5-minute lessons that meal providers can give while people are waiting to be served. And I think I left out one of your programs, but the big one is if you do not have a network in your community and would like to be part of starting one, Michael's office is ready to help you do that.
Gail, I just want to add, the placemats are great. They're so easy for the senior to quickly get the information. And am I correct, they come in English and Spanish?
That's correct.
A number of them do come in Spanish. And I will say that if you find the word game a little bit hard, we did that intentionally because when we sort of tested it, the first version, a lot of the people we were putting in front of said, this is too easy. Give me a little bit of a challenge here.
Good. So very responsive to your audience.
Yes.
So thank you very much.
Thank you.
Well, this concludes this session, and I'll turn it over to Matt, who will give instructions for what we'll be doing in the afternoon sessions.
Thank you. This adjourns the meeting for this afternoon. We're going to go into lunch. Thanks.
We are about to get back in order, and so I'd like to welcome you all back. And for our final discussion of the day, the final session is focused on trends in mortgage markets. We have two subject matter experts from the Bureau, Mark McCardle and Jessica Russell. Mark is the Assistant Director for the Office of Mortgage Markets, and Jessica is a Mortgage Data Assets Program Manager. And so I turn it over to Mark and Jessica.
Excellent. Thank you so much. And thank you for coming. It's always a great group to talk to. So today we wanted to just run through some of the housing and mortgage metrics that we watch regularly. It's sort of just a snapshot of the current market, and look forward to the discussion after the presentation to understand how that meshes or doesn't mesh with what you are seeing in your markets and on the front lines. So if I could get the slides. Oh, perfect.
There you go.
There we are. So we'll talk through some macroeconomic trends, and I've switched the order a little bit from what's in your the paper copies. Then we'll talk about some general trends, and then end with a quick discussion on home equity borrowing. And this is just going to be a bit of a blitz, so hang on. I thought I'd start with homeownership, since that's one of the key metrics for the housing market. Currently at 64.3%, after obviously a long slide and then a recovery. I think one of the things we are still waiting to see is whether that blip at the end is a turn in the trend or just a blip. So that's something that we wanted to watch. But it's worth noting that when you disaggregate that by race, you'll see that there's a persistent difference between the homeownership rate between non-Hispanic whites and minorities. And we also think it's worth noting that Black and Hispanic consumers used to have similar homeownership rates leading up to the crisis. You can see that the blue and orange lines there. And then they really diverged, and they've continued to diverge in recent years, and that's something that we think is kind of worth knowing about and worth watching.
African-American homeownership, I think, is at a 50-year low.
Pretty close, yeah. And so nationwide, home prices, they're about 11% above their prior peak. So the graph here is just showing the change in home prices since 2000 to September, and showing the difference between where prices are today and where they were at their prior peak, which we think is an interesting metric. And you can see, obviously, housing is local. Nationwide, up 11%. Areas like Vegas are still down 15%. And if you think things are hot and busy in the DC market, then you haven't been to the West, because in places like San Francisco and Seattle, home prices are respectively 68% and 36% above their prior peaks. And this is a little dated, so the newer data show a slight turn there, but still very, very high home prices in a lot of the Western markets. And a lot of economists are pointing to sort of a shortage of homes for sale being one of the contributing factors there. Interest rates, obviously a key metric that we watch on a weekly basis. They spent most of 2018 above 4%, briefly hitting as high as 4.9, so not quite 5%, but almost. And then just this past week, went back under 4% for the first time. So obviously that has a lot of effects on the mortgage market, which we will talk about. So one of the big trends, shifting from sort of macro trends to what's going on in the market itself, is the difference between purchase and refi. And as many of you know, purchase is sort of a more stable, steady market, whereas refi tends to be more feast and famine based on what interest rates are doing. And so given the prior slide, it's then not surprising, perhaps, that purchase volume is increasing. So consumers, more and more consumers are getting mortgages to purchase a home, but refi volume has really dropped dramatically. It fell 34% in 17 and 29%, another 29% in 2018. So that refi volume, there's just not a lot left to refi. With the new drop in rates, maybe there's a few more, but still not the same volume. And that has a lot of implications for lenders and their profitability. Purchase mortgages are sort of take longer and are harder to make, and they're more work to do. So in terms of underwriting, wanted to show a couple graphs. These are from the Urban Institute that talk about underwriting so we're going to talk about FICO scores, DTI, and LTV, which are kind of three of the main characteristics you want to focus on. They didn't all three fit, so we'll do them one by one. FICO score. So I would say, in general, the credit scores are still are very good. The median FICO for a current purchase loan is about 31 points higher than it was in the early 2000s. So that's at the orange line at the 731. And then the blue line is the 10th percentile. So you can kind of think of that as like the lower bound. You really, if your FICO score is below this, you're probably not getting a mortgage. And so that's currently at 642, where it was in the low 600s in the early 2000s. So there we're requiring higher FICO scores than historically, which is a different story, actually, than what's going on the DTI and LTV side, where, again, this first one is CLTV, the second is DTI, and you can see both of them. The measures have become looser. So when you look at LTV, more consumers, your median consumer now has a 95% LTV. So your smaller down payments are more and more common. Similarly, your median consumer now has a 40% DTI at origination. So those two metrics are getting looser, while credit scores are remaining generally pretty high. So I know sometimes we talk about access to credit and what are underwriting standards loose or tight, and I think sometimes it's nuanced because it matters on which metric you're looking at. On the servicing side, just worth noting, as we all know, that delinquencies continue to be near historic lows, which is, I think, good news all around. We have seen some blips around, natural disasters and the government shutdown, but in general, delinquencies continue to be very low. And I would say if there's any upside to some of the recent disasters and whatnot, it's that it has given servicers plenty of practice at understanding how to process these loans. And what we're hearing is that they're getting better and better at that. And then, and this is where I switched your slides around a little bit if you're following along in paper. But lastly, I want to just touch on home equity and home equity borrowing, because I think that's kind of something that people think about when we compare it to historic trends. So this graph shows the overall market size. So essentially, if you were to take all the U.S. residential homes and you were to add up all of their value, you get about $27 trillion. That's a trillion, not a billion, $27 trillion. And of that, about 16.4% is homeowners' equity. That's that gray there, which is a humongous increase. I think that's the technical term for it. It was, let's see, closer to 6.8 around 2011. So that's nearly a $10 trillion increase in homeowners' equity. And you can see that, meanwhile, mortgage debt is also increasing, but not nearly sort of at the same speed as it was in the past. So I think that's worth noting. Consumers have a lot of equity. Much of that is considered tappable equity. And yet what we see is that consumers are showing a fair amount of restraint in using it. So this graph shows cash out refinances against rate term, or sort of your regular refinances. So the cash out refi is the sort of teal color. And you may hear these headlines that are like, oh, 82% of refis are cash out. And that sounds maybe kind of concerning. But a lot of that is just the disappearance of the green, the rate term refinances. When you actually look at the overall cash out refi volume, it has increased, although in 2018 it was down a little bit. But it's still pretty modest, I would say, compared to where it has been historically. And again, especially when you compare it to the previous slide, where consumers just have a massive amount of tappable equity that they could be using and aren't. So we think that's sort of something interesting to see, especially from the consumer behavior side. And with that, that's the end of my slide. So I'll turn it back over for the discussion.
Okay, this is very, again, interesting information. Certainly, there are a lot of drivers behind these trends, and maybe from the ground perspective, both from the financial institution side as well as from the consumer side, we might be able to get at some of those factors that are leading to these results. And then the question, of course, is will these trends persist? And so, open up.
Oops, sorry. I had that off. Excuse me. But I did have a question, a couple of questions. Yeah.
Oh, one other point of order. It's a little easier if you flip your card up like this, so that then we can call, because they're getting some feedback when several of the mics are on. And then the other thing I noticed is that sometimes someone will have their mic on and then the light will go out because the system only holds 4. So some person gets knocked out and they're out of the loop. So if you just put your card up, we can then call on you.
And I've silenced my phone, so I'll put my card up the next time I want to have the microphone. Thank you both, Mark and Jessica, for the presentation. I have questions about the Bureau's data that I didn't see reported today, but wondering if you have collected and can report on data related to the fact that redlining is still happening in this country, including it's a significant problem in the city of Atlanta. I know that's shocking, but anybody who would like me to send them the data, I will send it to you because it is there. And then I would ask if you have thought about or looked at that chart that shows that black home ownership is at a 50-year low, and that's something not at all, I mean, we're very well aware of that and what that means in terms of overall financial well-being for communities of color. Did you look at that in terms of the ages? And I'm wondering if there's a generational link there, as what we're, anecdotally observing is that as seniors are now seeing opportunities, they probably, maybe they've owned their homes for most of their adult lives, and they may have paid, $5,000 to $8,000 for it, and they can suddenly realize, hundreds of thousands of dollars. And so we're seeing neighborhoods where a lot of that is happening, so that seniors are, and obviously passing away or moving into assisted living or some other arrangement. But we're seeing a trend with younger blacks that they're not interested in buying a home. And that's, I think, across the board, we're seeing that millennials are much less interested in buying a home. So I'm wondering if you could look at not only the disaggregation of the data by race, but also by age, and if that might be instructive in terms of why you're seeing such a noticeable drop with black home ownership, even compared to what had been close with Hispanic ownership.
Yeah, great, thank you. So to your question on redlining, I would say, obviously, we have the HMDA data, which is sort of the preeminent data set that we use for that because it has the race and ethnicity categories in it. And hopefully, and are looking forward to using the 2018 data, which will have expanded information, including additional fields that'll help see how much of the discrepancies are sort of explained away by differences in things like credit score or DTI, which wasn't available before. In terms of where we are in terms of looking at specific redlining, I'd have to defer to my colleagues in our fair lending office, since they're the ones who are focused on that. And but I know that they're constantly looking at it. I know they're excited to be using the new HMDA data.
I can, Jessica, I thought you'd actually get to the latter part of the question, so I can certainly talk about redlining, but please keep going on the next part of the question, which I'm also very interested in the answer.
Great, yeah. So your second question on the differences in home ownership, so those data come from census. I'm not sure offhand if I know they have age breakdowns. I'm not sure if they have the race age cross.
I have not seen that, age and race. Yeah.
I haven't seen it, but we could go back and look. I will say, I think that the point about seniors cashing out is very interesting, and that's part of why we want to come to CAB to see what people are seeing. I will say on the sort of millennial and younger home buyer questions, I think that raises a really interesting question, because at least the surveys that I've seen actually say that millennials do have a strong interest in owning and buying a home, in many ways actually higher, and I don't have the numbers offhand, but I want to say that it's actually higher than the boomers, and in some ways is more similar to their grandparents in terms of aspirations.
Fannie Mae does a study on that.
Yeah,
right?
on home ownership. And really the difference then is less about what they aspire to do and more about what they have the capacity to do, given sort of their current income levels. And also, again, looking back at the home prices, when you've got,
Student debt on top of that.
Student debt, but also just sort of, you've got looking at the wage growth and comparing that to the home price growth, I think is important. And maybe I don't want to go too far on a limb, but obviously that's a driver there. So I guess to your point, I would be really interested to know if there is a difference between sort of aspirational sort of homeowner aspirations for young Blacks consumers versus young white or other minority consumers. I haven't seen any information about that, but I think that would be a really interesting sort of piece to follow.
I would echo that too, Liz. I'd be very interested in understanding that better. And there are some trends happening here. I think the question too, with respect to age and aspirations is, perhaps expectations too about what they would like to have and what they can actually afford, and understanding again the factors there. We've seen some correlation, of course, or at least some surmising that student debt has something to do with that. But again, it might just be where you live regionally too. The dynamics are very different in location. So again, getting some more refined understanding of that in the data that we're seeing, and understanding of studies that are out there to really understand this would be useful. Just to give you one last piece on the redlining issue, we are engaged in redlining investigations. We have been. And to the extent that any of them come to fruition, you will see that in the public sphere, but certainly something that continues to be a strong interest area.
Thank you. I'm glad to look forward to hearing that.
I think had his card up.
Right, thank
for a
you.
while.
Just a quick comment on supply, which is affecting a lot of this, and pricing. There's zoning and density wars happening around the country, just a lot of resistance. Just want to mention 3 types of alternate housing. Obviously, auxiliary dwelling units, which is kind of a zoning issue, but kind of putting something in the backyard, or even subdividing with appropriate safety approvals. This allows multi-generations to kind of hang together, share costs, and have a bit of privacy. Manufactured housing continues to evolve, very important, a good source of employment, but also very interesting. And I think some of that can be built to higher standards for resiliency in natural disasters. And then new kinds of senior housing as an example, where it's dorm-like, but they're shared social spaces, perhaps a shared kitchen, but private areas. I've actually seen those in Florida before. I think some of those are going to come back, and that could be actually an equity purchase by even children for their parent, and then they can hold ownership to that. But it's sort of a developer that I had met that built dorms, created something for seniors in a kind of a group setting. And then just finally there, and I know the director will know a lot about this, is as climate changes a bit, the issue of FEMA buying out homes, so that decreases supply, but, out of floodplain areas, other areas where new restrictions on building in the forest areas, interurban forest lands, that's a new phenomenon that is actually a cost to the government too.
Can I ask a question on the senior housing? Is that typically rented or is that purchased?
It's when I saw it as an investor, and I own a small company in Colorado Springs that looked at this, it was offered up to investors, and then we would rent to the seniors. So it was, and I didn't go into it. I didn't buy into that, but that's an interesting model. But I think if it were more made available more within families, that could be a really interesting asset to provide privacy, senior protection, and care. And it's it's short of assisted living.
Yeah, on that point, I think we're seeing some similar development with the younger generation as well, just in terms of I've noticed an uptick in venture capital flow into co-living type models, and they come in a variety of flavors. Some of these are more like rental buildings with shared services. Some of them, I think, provide for actually owning an equity interest in the shared development. I also wanted to add, on the question of home ownership among younger folks that, when we were looking at the average credit score for a mortgage, which I think hasn't moved significantly, the average credit score for folks in the millennial generation is still, I think, something like 625. It's still very low for folks under the age of 35. And so that can help to explain some of the gap between, sort of aspiration and what's actually available.
If I could add to that last point, I've also seen some interesting research that points to, interestingly, sort of down payment being a perceived barrier. And I think that's kind of interesting given the proliferation of low down payment options in the market today. So I thought that was also worth noting.
One of the things I would add is that, especially for African Americans, many of the cities where the housing prices have just soared, that's where the folks are. And as a consequence, given the combination, especially of those folks who have gone to college, and of course, for those folks who go to college, on average in the United States, 55% of African Americans who go to college don't finish. And that's, compared to an overall percentage of 55%. Or 45% that don't finish as the average across the country. So you have a lot of people out there with debt, and the student loan debt is a throwback to the kind of debt that they had in Britain, where people would have to go into indentured servitude because you can't get rid of it unless you pay it. So that debt burden is one of the big issues, and then the other, as I said, is that they live in places where the prices have skyrocketed, and then many of the locations like Atlanta, Dallas, Austin, increasingly Houston, the housing prices are skyrocketing because people in California and people in New York are cashing out and moving down and pushing the prices up, which then again means that the folks who live there can't afford to own.
One phenomenon we're starting to see, at least in Tennessee, is a number of our community banks that had pretty decent presences in the mortgage market have all decided to exit that market, primarily because of the graph you showed around refinance. There's just not enough money in it, and those folks were much closer to their local communities. And so it'll be interesting to see what you see in the data going forward for HMDA. The volume of reporters that are starting to show up and disappear as more and more of this is commoditized online. A lot of the local banks are just, we can't do it. It's too hard, and there's not enough volume for us.
I'd like to share our experience from with Michigan State University Federal Credit Union in East Lansing, Michigan. So we do mortgages just in the state of Michigan, but we're starting to see some of that aspiration become reality from the younger home buyers. We, in the last 12 months, unusually or inconsistent with what we've seen prior to that, we're seeing a lot of first-time home buyers and really young first-time home buyers, like under the age of 25. So 1/3 of our applications right now over the last 12 months have been first-time home buyers. And from a volume standpoint, we have 500 applications in our queue as of last week. So we're getting a ton of applications. And again, 1/3 of those are first-time home buyers. However, we're seeing a lot of cash above close come in. So there's good, DTI statistics, but those, I don't know if those are incorporating what the actual purchase price of that property was, because we have a lot of these younger borrowers. A significant number are getting gifts that they're bringing, gifted money that they're bringing at close, and that's above the appraisal price on the property. So they're coming, they're buying, their purchase price is well above the appraisal price. They need a gift to actually get in the property and purchase it. So we're seeing a lot of that as well. And then we're also seeing, just from our risk for these members as well, is as we evaluate assets really across their membership, we're seeing less and less retirement funds in retirement that our members have as they come to the table for a mortgage application. And again, that's maybe not affecting their capacity to pay, but we are noticing that as a trend in our mortgage applicants. And then one of the things that may be helping spur some of the younger members to homeowner applications is 9 months ago, we put our mortgage application on our mobile app, and we're already seeing 40% of our mortgage applications are now coming through the mobile channel, which we perceive as the adoption from the younger members.
There's a lot there that's really interesting. I'd love to hear more, if you have time, about the younger borrowers and what you feel like, if you see any difference between their perceptions of their ability to get a mortgage and whether their actual ability to get a mortgage. And also, I think your point on the mobile side is dead on. I think that's also one of the topics we had hoped to cover in this as well, is just the incredible growth of the digital mortgage in all of its various forms, however you define it. I think is a huge, it's growing very rapidly. I think it has a lot of potential. So.
I'm from a small Midwestern town. We've got 12 applicants that are approved for FHA credits, but no homes to buy. So it's a real challenge. I mean, even in the state of Indiana, affordability of housing is definitely a problem. So it's, we were a big manufacturing state with autos and GE and Westinghouse, and now they're all gone, and we have biotech companies that pay a lot less, candidly, and have a lot less benefits, and makes the affordability index a challenge across the state.
I'm going to echo that. What we've been talking to a lot of our rural communities about is home ownership. They can demonstrate the demand, much like you just did, but there's no developers who want to go into those communities and build houses. And so it's not just an urban phenomenon. We're seeing it almost as much in our rural markets as we see it in the urban markets, at least in Tennessee. We're getting a lot of manufacturers coming into those rural markets, and there's nowhere for the people to live and buy homes. So we actually have communities that have done the study of the demand side of it, and are trying to get developers to come in. And it's just a tough thing to swing to get a developer to go to a rural market.
Yeah, we the graph I showed on the prices by market, we have sort of a bigger one that we have internally that looks at markets, and we put Fargo on there for a while because we thought that was an interesting one to watch, and the price growth there was also really outstanding. So I think your point about rural is really interesting.
And when I mean rural, I mean these are counties of like
very rural.
4,000 and 5,000
Yes.
people in the county.
Yeah.
I mean, these are very small counties where there hadn't been a new house built in 20 years.
I'm curious if other folks in more rural areas are also seeing that.
Yeah, one of the challenges you have in rural areas are the appraisals, and third parties don't like the appraisals. The adjustments are too high. The comps are miles apart and aren't terribly comparable, but they're properties that have been sold. So there's just a lot of infrastructure problems in the rural marketplace, and then trying to determine a price for a property in those communities is very difficult. It just kind of comes down to how bad did you want it. It's unfortunate, but there's no kind of equilibrium in the marketplace. There's just not enough activity to arrive at that.
One of the things I think that's important to look at, because we see it in the Bay Area and California, you've got organizations like Facebook and Google who were thinking about displacing tenants and buying properties to house the employees that are coming into the town. And, if those of you who go to the Bay Area, go to LA, there's a huge issue with homelessness. And so some of what we're talking about here has a lot of ripple effect, right, in communities. And I think it's important to kind of look at the more holistic picture of what the data tells us as people, whether they're African Americans or Hispanics or others, home ownership is not keeping up. What is happening, right? Because now these folks have to live further away from where they work, what's happening to small businesses. So there's a much broader implications that I think would be good getting some insights about what this means into the economy.
Yeah, for sure.
Well, I also wanted to add that it's not just the price that you pay in terms of buying the house. In many communities, certainly urban communities, the property taxes are just a killer, and they go up every year. And as a result, there are seniors who have to move. They have to move in with relatives and sell because they just can't. They can't keep up. Even with the there are some places where seniors are protected, but most places have a I forget what it's called, what it is, like a $50,000 grant that, and then above that you have to start to pay, and so that's one of the features that makes it very, very difficult. Your income just doesn't keep up with the cost of a house.
I had a question about the data, the HMDA data that's being relied upon. It seems that just from analysis that I've performed, in certain cases there seems that there's an uptick of, and it seems like it comes probably from some more online lenders, which is probably to be anticipated, but a lot of information is being reported as not provided, that they didn't wish to provide it. Has that impacted the analysis of that data, where there can be an uptick where it's very opaque, that we don't know what race or ethnicity is being reported because they're choosing not to provide it, and particularly if it's online, there's no interaction to be able to make some sort of determination?
Yeah, so I don't have those numbers on with me. I know that the Bureau has looked at that. I'm not really yeah, I don't know.
Later on this summer, we'll have a data point paper, and one of the things we're going to look at is GMI and HOF, and it was reported. So, and as you're right, if it's an in-person application, they have to even guess at but online they don't have to do that. And so, with the share of online going up, it should have an impact on that. But we are doing that analysis right now. The one gentleman mentioned you were using the mobile app and you saw an uptick of that. Are other folks dipping their feet in the digital waters? And any experiences you want to share?
Oh, yeah, we do that as well. Yeah, we get a lot of mobile applications on mortgages, and they really don't, it's interesting, but they really don't want to talk to you.
Right, they just
want to fill this out and move on, and don't share any information. Oh, do I have to listen to you on the disclosures? I mean, that's the way it is. I mean, as far as the disclosures are concerned, I hear it from people all the time. Well, I signed my name 14 times and I walked out, and and it's unfortunate. They have a little bit of responsibility on their own to understand the obligation that they've committed to. They just don't really want to hear it. All they care about is the house and getting it closed and being done. So you got to kind of force them, whether they want to hear it or not. But it is definitely a challenge.
Yeah, I'd also be curious, are you all looking, when you're talking about digital, is that sort of applying online, mobile apps, e-recording, remote notary? I'm kind of curious which there's like this whole suite of things that people talk about when they talk about that, and I'm never quite sure which of those pieces people are using.
The GSEs have pilots that help you do underwriting using bank account data.
The more automated validations.
We're investigating solutions to provide those services, and so that's on our roadmap. We started with the application process, and now we're working for data validation, trying to more automate the underwriting of that process. We're also looking at opportunities. To Brian's point, a lot of our members just want to apply, and then there's a lot that's going on behind the scenes, and we're trying to provide them insight as their loan file is moving through the process and what steps are coming up and where that's at, so that they have a little bit of they can log back into their application and see from a self-service standpoint. They don't need to call in and say, where are you at in this process? Again, to give them clarity, because that's where we see a lot of, members are confused about what the process looks like and what I should expect. And the more that we can be upfront with them on what they can expect and where they're apps in the process, kind of like pre-servicing, I think, service. And then I think I already brought up the decisioning, and we're looking at solutions for that.
Yeah.
So.
Great.
My question's sort of off of getting away from the mobile app for a second. It's more of a curiosity question. So this $16 trillion in equity, where is it really coming from? Why is it grown so fast? Is it because, older Gen Xers, maybe baby boomers, have been such good savers that they're just not wrapping up debt into equity, or where does it really come from?
Yeah, it's a good question. These numbers come from the flow of funds, so that the Federal Reserve puts out. So I don't have a good way of kind of necessarily breaking out all of the pieces. It's a few different things, though. So contributing, obviously, the increase in home prices is one of the big drivers. There's the sort of natural amortization of the mortgage is a piece of that. And then there's also just the group of people who own their homes outright and who are buying in cash. So that's, I remember when I first looked at the cash share numbers, I was sort of like shocked at just how high they are, especially in some markets. And I think, oh gosh, I'll have to look at my notes, but the number of people who own their homes outright is also it's certainly higher than I think most people would expect.
Do those numbers include venture capital homes that were purchased during the downturn?
Yeah, so the federal flow of funds, I'll have to double check. It does include, so it's residential housing, not necessarily owner-occupied consumer. I think when we've looked at that, I don't know that we've looked at it for the equity. I know we've looked at it for the mortgage. It takes it from, I want to say close to, it's I'd have to go back at my notes. I want to say it's $1 trillion-ish when you go from including everything that's in the flow of funds to just including those that are sort of your consumer ones, which we can validate against data that we see in consumer reporting. Sorry, consumer credit reporting.
Do you know, as the home equity numbers, are those total outstanding debt or total lines of credit?
For flow of funds, I believe that would be the amount that's being utilized. Don't hold me to it, though.
Well, again, this is, the mortgage market has changed dramatically, as you know, and there are a series of factors and hangover effects from the previous experience that may be, in fact, clouding the data at this point, which then means that it's hard to determine what the trend is. The tax law changes will have an effect over time. Simply because, the SALT doesn't matter anymore. And I know that when the 86 Tax Act was passed, in anticipation, I tried to move apartment property I owned here in Washington, D.C., and unfortunately, Black Monday happened, and the person who was buying had his money tied up, and so I wound up getting caught crossing into the next year, and I know what that meant for me and for others who owned investment property. They just got whacked, and so the changed tax law is going to have some impact, I think, as we go forward, and may also explain why a number of people in certain locations not only are they may be cashing out because they see the topping of the market, or they're cashing out because they're saying, whoa, I can't write off the taxes. And I certainly know I sold my place in Houston because I was in the unenviable position of paying a huge property tax in Texas because there's no income tax, but living in Georgia and paying an income tax. And I said, oh God, this is insane. So I just think that we're in a window here where things are just like the washing machine is washing, and we really not going to be able to get a clear sense. But if you start to look at these tracers, you may be able to figure out what's really going to keep propelling up or taking this down or keeping it flat.
Yeah, there was some data from the Tax Policy Center which indicated that the folks taking the mortgage interest reduction fell from 34 million, which was 20% of returns in 2017, to 14 million, only 8% of returns in 2018. So that's tax policy has a big impact.
Yeah, I would say on the home equity front, for what it's worth, the conferences I've attended, people have generally said that, at least for home equity loans, in some cases, it's more the perception of the change of the law than it is the actual tax consequences, since there are still circumstances where you can use home equity and deduct it. But they didn't. But even that aside, they didn't feel like that was sort of the primary thing holding the home equity back.
Eric from Austin Capital Bank in Austin, Texas. We're a small community bank, and we actually exited the mortgage market with the advent of Dodd-Frank, the consumer mortgages. We re-entered last year because we knew we could do it at scale. I think a lot of community banks have exited this market because you can't do it at scale. We did about a little north of 100 million last year. We'll probably do just shy of $500 million this year. About well over 90% of our loans are purchase loans. And so I convened the team because I know just enough about mortgages to be dangerous. And I asked them to make me look smart today. And after they told me that was impossible, I have just a couple of feedback points from the set of questions we have, which one of the things that they said is driving potential consumer harm is the time frame requirements for disclosures for closing docs, and that there's no ability for consumer to waive those. And so that often consumers run up with additional rate lock fees or go out of contract and have to pay a contract extension. So there's actual monetary damage to the consumer from the law that's protecting them. So for the ability of the consumer to actually waive that disclosure period at their will. The loan officers had some comments on compensation, and there's some nuances to this I know I won't get right, but they also wanted the ability to voluntarily reduce their comp if they made an error, and they don't have that ability. I can't really talk to the details behind that. In general, they said, for as far as TRID, that the forms are friendlier but not as transparent, and that they're much more hard to get accurate. And then for HMDA, it was sort of across the board. Everybody involved said it's too much, it's too burdensome. It's used as a gotcha. If you liked 20 pieces of data, you'll love 72. But so where does it end? And so what is this data actually going to be used for? And that, like, when they looked at the definitions behind this, it became redundant in a lot of the categories. I think there's a lot of interest in why are we adding so many different pieces of data, and what are we going to actually do with it to account for the burden of going through and doing a HMDA scrub.
On the HMDA data point, I'll just mention that many of the new data points relate to underlying credit characteristics, which you really need if you're going to do any kind of fair lending analysis. Before, you just had, race and interest rate, and you didn't have any of the underlying LTV, credit score, things that are part and parcel of a credit decision. So.
Mm-hmm. But I think it probably is important to note that we do have an active rulemaking and comment period on all of those issues, including the data points. So certainly getting the feedback and perspective on that. And I can tell you from a philosophical standpoint, there are a couple things going on here. One is some of the data points are required by law. So obviously those are data points that we will collect and should collect. HMDA is a disclosure law, so there is some issues around privacy too, and concerns about being able to map back to the individual and some things there. But the overriding purpose of the law is disclosure. But the last thing I would say is that philosophically, from where I stand, recognizing the two things I just said, being the starting points for the conversation on HMDA, if it is data that we are not going to use or cannot use, we should not collect it. So it is with all of those things in mind that we're moving forward on the issues that you raised, Eric, too. And I will say, even though you think you don't catch the nuances on LO comp, that is one of those things that I have now heard a lot about, and I think you did it justice. So you can tell your staff I said so. But it is something that at least we have heard and know is an issue out there.
And to follow up on Eric's comments, with respect to TRID, is there, I think every few years you look at the regulation, because that is one that I think the clarity, even though some of it may be a little bit more opaque, but it's in a more understandable manner. But from the execution standpoint, from the financial institution, there's a lot of trip-ups and so many nuances with it. It does make it very difficult to comply with all of the myriad of, round here, dash here, this, an appraisal fee can't change, but we don't have control. We have laws that require us to rotate appraisers and things like that. So we're rotating appraisers. Every appraiser doesn't charge the same fee. So, we can be off by a little bit, which isn't us trying to slight anyone. It's just how it's coming up on our appraisal rotation. So there's a lot of, even though the grander aspect of it, I think, is good, there are still so many aspects of it that make it very difficult to actually execute from the particular community bank standpoint.
Yeah, we are undergoing our TRID assessment right now, so it should be due in October of 2020, and we're looking at all of these points in particular. I mean, we've heard them repeatedly, especially about the materiality of mistakes. How do you correct mistakes? Those come up again and again. And some private sector players like SFIG, have made some progress in sort of creating thresholds for errors and what you should look at on TRID. But that's good feedback. We look forward to working with you as we go through the assessment.
I would just, and follow up to what Dr. Kraninger just said about the importance of having data that's going to be used and maybe not collecting data that doesn't have a use. And I'm going to think back to, again, what David said this morning. Metrics are only as good as the data. And I wonder if how the Bureau approaches determining what you want to measure. What are the metrics that's intended in what the law says you should do in dealing with this rule, so that you're designing the data towards a specific set of key performance measures, so that we know what's the outcome. Do we know when we're starting this data collection process what specifically measurements we're going to use the data in order to change what specific outcomes?
For HMDA, you mean? Well, for this conversation. Yeah.
No, and for, it was certainly that point on HMDA, but from a global standpoint, I absolutely appreciate where you're coming from, since we were just talking about TRID a second ago, too. I have been having at least extensive push and pull, probably with the staff is a good way to describe it, on how we engage in the assessments, how we engage in the rulemaking process, to really think about precisely the issue you just raised, because Congress gave us the responsibility to assess whether rulemaking actually met the outcome that the agency intended when it was issued. And so we're trying to think back, and maybe debt collection's a better example of that too, in terms of thinking about, we put out the NPRM, we're a while from a final rule, but 5 years after we issue that final rule, we're going to have to tell the country whether the rule actually met the outcome that we were trying to meet. So thinking now about how will we evaluate that? What kinds of information is available in the marketplace or not available that will help us think that through, so that we truly have the evidence base moving forward to make that assessment meaningful and real. And so certainly we are absolutely engaged in that conversation to think that through from the beginning of the process. And we, of course, have a number of rules and inherited rules that we're going to have to be thinking about as well, in terms of looking at just more the 10-year and Regulatory Flexibility Act review requirement. That's not exactly the same, but just in terms of, from a philosophical standpoint, assessing whether the rules are effective, we absolutely are trying to get a good sense of that. And I think that's precisely why we have the data collection authorities that we have. And so using them smartly to do these assessments is a priority.
Well, it's about time for us to begin to wrap up our discussion for this meeting the last 2 days. And so first off, I want to thank Mark and Jessica for really not only giving information, but really willing to hear and to respond and help us think through how you're seeing the issue. And essentially, that's one of the things that I think prompted Liz's question, is the eyes that you look at this information, that you use to look at this information is really important. I think of the effort that we've engaged in the same way I think of a university. I see a university as a place where there are people who are helping people who are going to go out and help people. So there's a upside down pyramid. And essentially that's what has been done here today, that we have assembled the various committees, advisory committees, to come to provide some insight and experience to the staff of the CFPB and, of course, to the director, that would then radiate out throughout this country, helping people to be able to live their lives in a productive manner, helping people to contribute to the growth of this economy, and then helping future generations. And so it is very, very important what has happened today. I'd like to thank Director Kraninger, also Deputy Director Johnson, who has been in and out, Andrew Duke, Matt Cameron, of course, and all of the Bureau staff and, of course, the advisory committees for the discussion and the work that has been done today in these important meetings. I truly believe that what has been discussed will emanate and radiate out for the betterment of our overall society. And I know that the Bureau takes this seriously and will be using this discussion along with other information as the Bureau contemplates plans for next steps in the areas of in its areas of responsibility. And so with that, I'd like to say that the meeting is adjourned. And again, thank you.